We have to remember, with rates being higher, it's more costly for people to borrow.
Our best guess continues to be that there are some earnings disappointments out there.
Part of the reason we have a challenge right now is the equity market is way ahead of itself.
It's one of those environments where the market is heavily biased towards pricing in a recession.
The consensus right now is expecting a recession to start really in this quarter. It just doesn't seem like that's going to happen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. It's Inflation Wednesday. Bramwell's been up all night trying to figure out the vectors of inflation. There's really no other story today, Lisa. There's this, that, the other thing. Ferro's on assignment. The answer is Inflation Wednesday.
So we've been worried about the banks. Now we get to worry about the fundamental economy and how much the Fed still has to do at a time when people are still pricing in rate cuts. And I think that's really going to be the focus. Is today the day where they price it out of market expectations simply because inflation is just too sticky?
You go right to the heart of the matter for me. We're going to be talking about this through the day, and we begin strong with Peter Oppenheimer of Goldman Sachs. So stay with us here for a lot of different briefs here. It's the inflation vector. And I think if you want rate cuts, the vector has to go down is the game plan.
Yeah, well, either the vector has to go down or there has to be some sort of crisis. On the banking front, we haven't seen any real signs of a percolating crisis that's ongoing. And on the inflation side, it seems sticky. So something has to give. And why do markets keep pricing in that it's going to be the crisis side? It's going to be the idea of disinflation.
I like what Peter says, talking about neutrality and a neutral call on the market. Mario Gabelli will join us at the top of the 8 o'clock hour, widely anticipated. You know, like Ferro reads Barron's every Saturday morning.
He does. He gets his
what's
cup
Mario
of tea
doing? What's
and
Mario
tries to
doing?
figure out
What's
what's going to
Mario
happen.
doing?
And how many people are going to have to talk about the debt ceiling as well as, what's going on
Really?
with
You
respect
think so?
to... They kind of have to at a certain point because there's been stasis, and that's what all of the reports have been reading about because the inflation vectors, people are saying, are sticky, period, full stop.
Do you think after the coronation, the King of England kicks the can down the road? I mean, is that what we're going to see in the debt ceiling? And that's what they do in the United Kingdom,
you think
right?
There's like a royal debt ceiling?
The royal can.
Yeah, well, just because I'm sitting in this chair doesn't mean I can comment on the royal debt ceiling.
We're going to get to this. I do want to frame the inflation debate, though, right now. And, Lisa, it's real simple. There's this service sector angst and the goods angst. Someone like David Rosenberg is expert at this. But I don't think people understand the disparity of 7.1% services inflation. Thank you to my accountant. And goods up 1.5%, almost disinflation to true deflation in goods.
The problem with this, I mean, if on one hand you could say you are seeing disinflation and then the services side will follow. The problem with this is you could say, all right, when services starts to cool off, you could see a reinflation of the goods. This is the push-pull of the bifurcated economy that leaves people concerned about a stickier inflation for longer.
Quick data check. It's indeterminate in the stock market. A fractional down. SPX down 7, Dow down 49. And the VIX to me is a big deal. It really just doesn't want to crawl out over 20, 18.02 on the VIX. In the yield space, I was away yesterday. Shock up 4.2, two-year yield 4.04%, a 3.50% on the 10-year. BitDog's done nothing after that, off 1,000 a couple days ago, 27,585. You think Ferro quotes BitDog? I quote BitDog.
Guarantee that he does not.
He does not.
Quote
and
Bitcoin
critically,
or BitDog.
In the spread space, I'm looking at 3 months 10s, which is coming a little bit of disinversion, negative 180 basis points. Petroleum elevated over the last 2 or 3 days. This is elevate to a morning brief. Lisa nailed this. She was at 2 p.m. on inflation, 2 a.m. on Inflation Wednesday to get the brief ready.
2 p.m., 2 a.m., still here. 8:30 a.m. is when we're really looking for that inflation read. I'm looking at the core inflation, much more than the headline inflation. The expectation is for it to come down just a touch to 5.5% year over year from 5.6%, but it was crawling higher in the prior reading. That is a problem. How hot does it have to be for this market to really sell off? Today, we do get sort of the other pole of the market narrative, a focus on regional banks. First Citizens, which bought SVB, is going to report earnings pre-market. They've got a 9 a.m. call. Interesting to see how this affected them, what kind of assets they really took on their books.
I'm off this story right now, but the truth is it's been a 3 or 4 days of just ebbing away. Is that the right idea?
Well, the interesting thing is calm. is good, is what we want, right? And then if you take a look at that KBW bank index, you could see it's not done anything. So even the calm hasn't given people that confidence to go back into these. And after market, Disney is reporting earnings. I actually think this is going to be important. The shares are up almost 18% year to date. This is a fantastic read on the fate of regular cable news, right? So we get a read on that. We get a read on advertising. We get a read on the experience side of things, the services side of things. And then we get some sort of view into media and how the sands are shifting with the social media push and where people are really consuming programming.
There we are. Disney this afternoon looked to remain Bostic and Scarlet Fu for that coverage late in the afternoon. Again, futures -7. He is in London, where he holds court as chief global equity strategist at Goldman Sachs. Peter Oppenheimer has decades of experience of extracting ourselves from the worries of the moment. Peter, thank you so much for joining us. And I love what you say in your research note about finding neutrality, a neutral view. What do you do in the stock market when you have a neutral view?
Well, Tom, we've had that view really through the last year. We've been calling the market environment fat and flat, relatively flat returns at the index level with quite wide trading bands as the market assesses at different points the relative risk between recession and inflation. And I think we're at the top of that band at the moment. And what we've been arguing is that within that, you're going to get quite a lot of alpha opportunities. Generally, we've been pitching it as a balance between some deep value, where we think the risks to valuations are very low, and quality growth. And the combination, we think, is really where investors should be in a relatively flat index environment.
Peter, over the past 10 years, everyone was a macro trader. And in the past 6 months, everyone's become a micro trader. And I go to Bank of America saying for the first time since the 2008 crisis, there is evidence of a stock pickers market, of individuals going into stocks over ETFs. Is this something that you think is going to be persistent, that we are actually shifting away from some of the broad indexes and really meaningfully clients looking at specific stocks?
Yeah, I think that's right. Look, in the last decade, really, equities and all asset classes have been dominated by one thing and one thing only, and that's a zero interest rate world of very low cost of capital. And that's really driven an environment where valuations of assets have gone up. That's been a major driver of returns, which we're not likely to see again to the same degree. But it also generated an environment that was very factor-based. Everyone wanted growth because it benefited most from that backdrop of very low cost of capital, and everyone was neglecting value. And I think it's much more nuanced now. You're seeing some really good earnings coming through across different sectors of the markets. We're also seeing different leadership geographically as well. We've been arguing that Europe would outperform the US, and it's been doing rather better in the last year. I think that will continue. So I think investors need to be a bit more nuanced, more diversified, across regions, across sectors and factors. And it really is, I think, an environment where stock picking and alpha creates a better opportunity for investors relative to just beta and index investing.
Well, that makes a concern around the fragility of markets when there is a shock that people are not prepared for. And I wonder if, for example, today with the CPI report, we end up with something that is much hotter than what people expected. If there is that vulnerability, even amid all of this sort of malaise around the macro trade, to suddenly say, oh, my goodness, I need to pay attention again.
Yeah, I think, look, the macro is going to be critically important because we're close to inflection points, and it's always an environment where investors become particularly heightened to risks or opportunities around marginal macro data. I think, as you described in the introduction, we're in an environment where inflation is still pretty sticky, well above what the central banks really want in terms of their targets. And there are some risks still on the downside in terms of the economy. At the moment, I think markets are really pricing the best possible outcome. The bond market's pricing rate cuts and inflation coming down. The equity markets are pretty much pricing a soft landing. That combination is possible, but it's really what's priced. And I think at the margin, our view is that interest rate expectations need to adjust to being higher for longer to get inflation down.
Peter, before we get back to inflation here, I want to tag team you and Jeff Curry together, and this is on hydrocarbons. And I look at Shell PLC, obviously with a higher dividend than what I see with ExxonMobil. Goldman Sachs on owning big oil on the continent or big oil in America. How do you choose?
Well, we like energy and commodities generally. We think that prices will rise from a fundamental perspective, as Jeff has been arguing. But also these sectors are very, very cash generative. They're paying dividends and they've got free cash flow yields, in the mid-teens, particularly in Europe. So energy and resources were overweight in Europe. We like resources in particular in the US. But these areas of the market, we think, have very low valuations. They don't have a lot of downside risk in terms of valuation. And they've still got an opportunity to, I think, accrete returns and compound returns for investors over time in a flat market.
Peter, if you and Jeff Curry are ever in New York City, or we're there in London, whatever, we'd love to get both of you on desk with us at the same time.
Great.
That would be just a really great moment. Mr. Oppenheimer's with Goldman Sachs starting this morning with a neutral view. I did get some enthusiasm there about energy. And again, everything I've heard the last couple of days is about where's the free cash flow. You can describe it however you want, but it's operating cash flow. Take out the CapEx. Here's what's left. What are you going to do with it?
And there's
Very
a lot left because, there's a lot left because where are people going to invest if they don't necessarily have the confidence that their projects are going to have long-standing power if people are investing in other things? It's
Inflation Wednesday, but Lisa, and you're the one that pointed this out to me, in so many things we're looking at, particularly in fixed income markets, everything's sort of in-betweeny. And there's this math phrase, indeterminate, which is sort of a mystery out forward of are you going up, are you going down? And to me, massively, as we go to 8:30 this morning, it's all sorts of equities, bonds, currencies, commodities, signaling an indeterminate trend. What are they going to do to get out of it?
We were talking with Katie Kaminsky yesterday, who's a trend follower, and we were saying, what's the signal? And she said, the signal is not a signal. We're not getting anything. It's just all kind of nudgy. And it's sort of to your point. It's very difficult to know. Everyone's looking for a catalyst, not getting one, and then going back to sleep.
Do you want to know another trend follower? John Henry. He owns a baseball team up in Boston as well. And it's a trend following that he has as well. The trend is they're above the dreaded New York Yankees.
Yeah, where were you yesterday? Where were you?
We were up there. We were trend following.
Yeah.
Stay with us. It is Inflation Wednesday. Good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. In the news this morning, a lot going on, especially when it comes to inflation. We'll get to that in just a bit. Right now, we want to get to President Biden and congressional Republicans. They made little progress toward averting a first ever U.S. default. They did agree on another meeting Friday, which will again include House Speaker Kevin McCarthy. The president said he viewed the meeting on raising the debt limit as productive. Bloomberg's learned New York Republican Congressman George Santos has been indicted on federal charges. He had been under investigation over possible campaign finance violations. Santos took office despite fabricating much of what he had claimed about his education and career. Former President Trump plans to appeal after a jury in New York found him liable for sexually assaulting a woman and then defaming her. It's the first verdict against him in a string of legal cases that threatened to erupt the presidential campaign. The jury also ordered the former president to pay the woman, E. Jean Carroll, $5 million in damages. Jurors stopped short of finding him liable for rape. A surprise move in China. A little-known local government official has been named the top regulator overseeing the $61 trillion financial sector. Former banker Li Yunzi will be party secretary of the newly formed National Financial Supervision and Management Bureau. The agency regulates thousands of banks, insurers, and trust firms. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Everybody in this meeting reiterated the positions they were at. I didn't see any new movement. The president said the staff should get back together. We explicitly asked Speaker McCarthy, would he take default off the table? He refused.
The United States is not going to default. It never has, and it never will.
I have been considering the 14th Amendment, but the problem is it would have to be litigated. And in the meantime, without an extension, it would still end up in the same place.
Be honest. Did you think the script would be anything else? 4 voices there on our American tradition of a debt ceiling. We do this in May typically, and we stagger to June, July. There are the worthies, including the President of the United States, after a meeting yesterday afternoon, I believe it was, at the White House. I was in transit. And, I'm really lucky, Lisa, that I missed the meeting. I mean, I wasn't like sitting up at 12 noon going...
Don't think you're so lucky, because honestly, there are going to be so many more, and they're going to be more.
Friday.
Exactly. So there you go.
Like Friday. So we're in this process, and you have an opinion, I have an opinion, and we'll get to it in a moment. Futures at -7, Dow futures -44, the VIX 18.02. As I mentioned earlier, just flat out indeterminate. I noticed oil with a lift the last 2 days. American oil, $72.72. And Lisa has noted the euro has staggered and plunged from 110. Down to 109.50. It's cratered. Right now, to give you perspective on this foolishness, Greg Valliere, Chief U.S. Foolish Strategy at AGF Investments, is once again we're sucked into the debt ceiling debate. Greg, is there something different this time, or have we seen this before?
I do think there's something different, Tom. Good morning. I think it's the militants in the House. There's at least 24 House Republicans who really don't want to raise the debt ceiling at all. They may agree to the spending cuts we got 2 or 3 weeks ago, but if there's anything more or any watering down, I think they take a walk. So that the House is a different dynamic.
Why do they have power? I mean, you mentioned 24. That's 24 voices among 300 XX and 100 senators, I believe it is. Okay, fine, but why do they have so much power?
Well, McCarthy only has a 4 or 5 seat majority. They didn't do very well in the last election. So with a majority that thin, a tiny minority has disproportionate influence.
Given the fact that it's a tiny majority, does Representative George Santos of Long Island, the New York region, does his indictment by the Department of Justice affect anything?
Not a lot. Frankly, what surprises me is that was a bigger news story than the debt ceiling. The Trump legal problems yesterday in New York was a huge story. But I think that one of the many surprising things about this debt default saga is that there's no real sense of urgency.
Well, part of this is because we've all seen this story before. I mean, we talked about this all of yesterday, that Washington's trying to get Wall Street interested so that they could use it as a pawn to basically go back to voters and said, we tried our hardest. I mean, this seems really circular. At what point do they just kind of have to bite the bullet, resolve the issue, or is it not going to get to that until there is a little bit more emotion and people care a little more?
I think it's the latter, Lisa. I think that they'll talk and talk and talk after extending the deadline. Maybe it's extended till the July 4th break, but maybe it's extended till the end of the fiscal year on September 30. There's not enough time to get a deal done because they're on vacation all the time. They only are in for another 7 or 8 days in May. They're out for a lot of they're out for a lot of June and July. So with this kind of a vacation schedule, I don't think they have time to get a deal done.
Meanwhile, Janet Yellen reportedly called all of the executives, the corporate executives, and they lined up dutifully and said, please don't do this. This is really dumb. You're holding the economy hostage. What do you think is going to galvanize some sort of reaction, given that the rank and file, yes, you have the polarization on either side of whether you want to cut the budget significantly, whether you want to keep certain spending and pare others, that I understand. The bigger debate is, why does this have to be resolved in this kind of, Brink's Edge kind of issue? How is it going to end other than some sort of massive move like the 14th Amendment or something worse like a default?
You could have that. I think you need one more ingredient, and that is a lot of demagoguery on Social Security. I think that's going to be a big part of the dialogue in the next 2 or 3 weeks, that senior citizens might not get their benefits. I think that will certainly motivate a lot of politicians. But you're right. It may take something outside the box, like the 14th Amendment. I think it would be a legal fiasco if they tried to do it. but there'll be an extension. We'll get a deal. I don't think the U.S. is going to default. I agree with Mitch McConnell, but it's going to take a while.
So we get an extension. The can is moveth down the road. You wrote in your morning note, it's something like autumn, or maybe it's the end of the fiscal year, whatever. Why the theater? I mean, if we're going to get an extension, I don't understand why the angst right now.
Oh, I think there are a lot of people, especially in the House, who sincerely worry. We've got a total debt of $31.4 trillion. All the projections are.
Greg, I don't mean to interrupt, but come on, you and I have been through this 5 times with the late great Pete Peterson. Where's the commission? Is that what comes out of the meeting Friday?
You could, although that would be viewed, I think, very, very cynically. No, I think there's a growing feeling among the public. You look at the polls, the public is convinced that inflation is the big problem, and inflation has been exacerbated by the spending. Right. So, I mean, in both parties, but especially the Republican Party, there's a militance that we've got to do something about spending.
Well, Greg, how many people are talking about where the spending comes from, right? I mean, on both sides, there's been spending, whether it's the Trump administration or the Biden administration. From your vantage point, where has more of the spending come from?
I think we're going to get in a deal eventually some curbs on spending. If you want federal benefits, you've got to work. They'll claw back pandemic relief. They'll have a cap on spending. I mean, there are the rough outlines of the deal that we'll get. It's just that this dance is going to take months and months probably to finally get resolved.
Greg Valliere, thank you so much for the brief this morning. With AGF Investments, folks, I can't say enough about Greg Valliere's morning note to get not the zeitgeist, but just the mood out there linking economics and business into the political ballet of Washington. The ballet is happening in Tokyo. Our Anne-Marie Horton in conversation Friday with the Secretary of the Treasury. This is the G7 finance ministers meetings. The timing on this is interesting. We'll have team coverage at 3:30 a.m. on Bloomberg Surveillance. I'm kidding. But this will be on a Tokyo time frame. Horton had a tantrum and said it's got to be 3:30 in my afternoon. So, okay, that's what we're doing. From Tokyo, Janet Yellen as well. I've been to these meetings, Lisa, and there's a lot of body language, but there's also a conveying of the message, and you wonder what Yellen's message is going to be to Anne-Marie Horton.
Especially when there's a fraught international stage and there's a fraught domestic stage, and the idea that how much does that affect the international stature of the United States as she goes into these meetings. This is a time that is crucial to try to get support around Ukraine in order to keep going with the potential offensive. This is crucial with respect to getting a number of other deals, trade and otherwise. How do you do this if people are like, what's going on at home? Are you guys going to default?
Yeah, what's interesting about this being in Tokyo is what Korea desires or Japan desires. And yes, China, Taiwan, and that down the Pacific Rim, but to remind ourselves, it was a bipartisan walkaway in the United States from the Pacific Trade Agreement of, I'm guessing, 7 years ago.
Did you see yesterday that Italy is walking away from its
the
Belt and Road agreement,
the yellow brick road.
You're killing it.
I kill it. Thank you.
Anytime. But this to me was really interesting because it was something that was, U.S. representatives really pushed hard against. They're withdrawing after entering it in 2018, 2019 area. But how much is this sort of, again, the sort of polarization? China, Russia, Saudi Arabia, maybe.
I totally agree with you. And what's fascinating is this was done by a controversial prime minister in Italy.
Yes, it was.
So that, this is something that, we'd have to get Francine Laquata Parachute to explain it. But the answer is it's a big deal. There's no question about that. The big deal here is in 2 hours. The inflation report of the United States of America. Michael McKee, of course, with the dynamics of service sector and goods sector inflation. The markets will move. Stay with us on radio and television. This is Bloomberg Surveillance. Bloomberg Surveillance, good morning. Good morning, Global Wall Street. Thrilled you're with us. Good morning to all of you looking 2 hours out to an inflation report in America. Where we've seen inflation, well, maybe a gallon of gas under $4 a gallon in most of Manhattan. That's a good thing. $72.86 per barrel on American oil. Brent crude well under 80, 76.57. Part of the inflation dynamic that Mr. McKee will slice and dice here at 8:30.
Although I do think that core, and exactly because of that point, core will be that much more important, stripping out energy, stripping out food, some of those more volatile areas, because that's the sort of sticky area of services worlds that you are talking about.
Many years ago, I dived into the research on this. Good morning to Loretta Mester and the Cleveland Fed and the Kansas City Fed that have really led the way on this. I'd also give credit to Diane Swank School, the University of Michigan, where there's been a lot of academics on it. And the answer is there's 14 ways to choose to measure inflation, and none of them are any good. So you sort of pick your, as Bill Aaron would say, your second best choice for it. Mine has always been the Cleveland core number, which doesn't just take out oil, energy, whatever, but varies month to month on what it takes out. I'm not sure that's the best number, but that's the one I've used.
I love the way that you put that, because this really is the reality. It's sort of, pick your inflation data and then come up with your theory. And what we're seeing right now is a host of projections from Wall Street. Let's get you some of them. Goldman Sachs is at the top of the pack, estimating a 0.5% rise in the core CPI month over month. Yes, they did. B of A at the bottom, calling for 0.3%. Citi in the middle, seeing a print of 0.4%. And this is really the game.
Can I interrupt? If it's a $30 pop at whole paycheck for groceries, why am I looking at a difference between 0.5, 0.4, and 0.3? I'm getting killed at the grocery store.
We will duly note that, and we will send that to all economists and say that Tom Keene at Whole Paycheck is spending a lot on his Italian artichoke hearts, and he would like to remedy that situation. Veronica Clark, among them, lining up to weigh in, economist at Citigroup. Veronica, I'd love your thoughts, not necessarily on Whole Paycheck and Tom's grocery bill, but definitely on sort of the vagaries of today's report and why you're expecting it to come in hot.
Yeah, we are now on the median. It's a 0.4, so we're right in the middle there, but it's a strong 0.4, so expecting a 0.44 month-on-month increase in core CPI. And a lot of the details really do matter here. A lot of the inflation data, I think it gets a bit more nuanced now. We're really looking at those core non-shelter services in this report. So that's recreation services, education, communications, expecting those to still be pretty strong.
You have been particularly vociferous, Veronica, over at Citi, you and Andrew Hollenhorst, about the stickiness of inflation, the need for this Federal Reserve to go further, of the market's sort of closed eye approach to what the reality is, which is that rates are going to remain higher for longer. What gives you that conviction? What makes you think that in some ways you're going to be vindicated with today's data?
Yeah, it really does just come down to the stickiness of core services inflation. And that's the inflation that's worrying for the Fed, because that's what's tied to very tight labor markets. And very low unemployment rate. Of course, we saw that on Friday, and strong wage growth. We saw that again on Friday, too. If you don't see the labor market loosening, if you don't see wages slowing, there's really not a lot of reason to think that underlying pace of inflation slows. That looks pretty consistently at around 5%. And I think that becomes more clear by the time of the June FOMC meeting. The Fed's latest forecasts look a bit too low for inflation, and they might have to raise those.
Veronica, let's do the Chapel Hill math right now, and that is you've got X number of inflation data points, and you establish a vector. I believe disinflation is the arrows pointing down. I definitely have a goods inflation, a vector telling me disinflation, maybe on a path to outright deflation. Which way does the vector on service sector inflation stand at 8:31 this morning?
Yeah, you make it sound a bit more complicated than it is, maybe. We're not really seeing true deflation in a lot of categories. We've seen that in energy, seen it starting maybe in food. And goods, prices have been softer, but those services prices are still very strong. We're not even, hoping for deflation. Mm-hmm. We're just hoping for a slower pace of inflation there.
I think it's a really important point, folks, as we model out rate cuts. Lisa's on top of the story 24/7. I could care less. But the answer is, I don't know how you model rate cuts if the arrow's going up on service sector inflation. How does real estate play in on that 7.1% service statistic?
Yeah. The shelter component of CPI is a bit more important here. We saw that starting to slow in March. And that should continue. We've seen home prices that have eased, new rents that are coming off, at least slowing, not rising as fast. And that should be reflected in that shelter component of CPI. That should continue. That will help things. But that is a really big component of CPI, but unfortunately it's a smaller component of PCE inflation, which the Fed will target. So PCE inflation actually might not come down quite as fast because of that.
Veronica, but the banks, there's going to be banking stress, and that will bring all inflation down. I mean, basically, that's the narrative, right? It's basically people have been waiting for the credit cracks to worsen. People read the, you can do it, sluice. How do you pronounce it? Sluice?
The sluice, yeah.
Sluice, yes.
I read the whole thing.
Oh, I'm sure that's the reason why you were out yesterday, just working through it.
Recovering from it.
The Senior Loan Officer Opinion Survey showed really whatever you wanted to think of in terms of, yes, a bit of tightening, no crisis yet. From your vantage point, how does this factor into your call that it's not going to necessarily matter for the Fed when it comes to their fight on inflation?
Yeah, I mean, that tightening of credit, we've seen that for a while. It was a positive, sign that we didn't see it accelerating, too much more in the Q1 sluice. But that will impact activity, that will impact inflation. But that's really a, further out down the line type of impact now. It's a slower tightening of credit. Which is, a more positive thing. But in the meantime, inflation's coming in stronger than the Fed was forecasting in March when, presumably they included some of that drag from tighter credit. Unemployment rate is still very low. So things are still evolving, stronger than they would have expected.
I imagine you get a lot of calls pushing back, Veronica. What's the most convincing argument against what you are saying?
Yeah, I mean, certainly markets are not pricing further hikes like we're expecting. We're also not expecting cuts, which they're pricing. I think the best argument is, there are financial stability, concerns. The Fed could want to be more gradual. It doesn't need to, quickly raise rates anymore. Maybe it takes its time and wait and see how things evolve. But I think in the meantime, they're still focused on inflation. That has to be number one. And if inflation's looking, stronger than you were forecasting, well, then rates need to be higher too.
Veronica, if I have a Hollenhurst-Clark call, which is maybe on the edge of Bullard, where we do get a rate increase, maybe even, dare I say, a second rate increase, what does my Bloomberg Treasury and money market screen do? Do you guys frame out SOFR or LIBOR? Ira Jersey and I are arguing about this. He says SOFR, I say LIBOR. He says call the whole thing off. But the answer is if I'm looking at 3-month benchmarks, or dare I say the 3-month T-bill, do I need to start modeling out 6.00%?
I don't think we're going to see rates quite that high. But yeah, of course, we look at short-term rates, and we are in that Bullard camp where we think rates are getting to a bit above 5.5%, which is certainly not priced. And yeah, it could make some of these deposit outflows a little bit worse. We've seen that for a while. People can get higher rates in these in T-bills and shorter-term money market funds, and that can continue. But that's part of the slowing of money going out into the economy that brings down inflation.
Veronica, thank you so much. Greatly appreciate it. Veronica Clark with Citigroup again with an important inflation call. I liked, Lisa, how you framed that with Goldman Sachs. Hotzi is pushing it up a little bit yesterday, and Bank of America maybe more quiet. I was making a joke about it, but there is, seriously, folks, a big difference between a 0.5, 0.4, 0.3.
Well, it's also the trajectory, right? It's a month-over-month kind of figure, and the year-over-year trajectory, especially with some of the revisions, will make a big difference to understand which data we should pay attention to in all of these disparate points of information. The
7-day SEC yield on a big fund company money market fund, let's check in at 4.98%. What does First Citizens do if it's a 5.48% yield after Veronica Clark beats it to death?
So we just did get First Citizens first quarter data, which is a little bit muddy just simply because they did buy Silicon Valley Bank. And so there's all of these acquisitions. And yet what you are seeing here is just a huge beat across the board. For example, they see deposits for the full year being $132 to $137 billion. The estimate was $119 billion, so far above expectations. They see a full year net interest income of $6.2 billion to $6.5 billion. The estimate, $4.02 billion, basically $4 billion. So a significant beat. How much is this simply because of what they acquired from Silicon Valley Bank? And how much does this sort of point to the winners and the losers in this whole kind of morass that's in the regional banking space?
On radio, we're showing the chart here right now where we get down to $5 per share agony, up to $8, and then up to 1,100, 1,200 on First Citizens. And what I would suggest is it's actually a technical breakout. You know, you look at the trading envelopes and the other fancy Bloomberg technical stuff, and unlike a lot of these banks or the Keefe, Bruyette, and Woods Index, this actually has a real pop to it.
Well, it sort of reminds me of a story that came out yesterday that big banks are increasing their salaries substantially, increasing compensation for their bankers, for their workers quite significantly, and regional banks are having to cut workers and cut compensation. And there's a consolidation in the bigger firms. And I imagine that this is going to be happening in the regionals too. The bigger, more stable ones will be able to hire the bigger, better people who will be able to bring in the business, and you'll get that ongoing consolidation.
I mean, I'm looking at the chart of JP Morgan here quickly. I'll just describe it to you folks because it's Wednesday. And the answer is it's very indeterminate, our theme for the day. It's right smack dab in the middle of the trading envelope where something like First Citizens entrepreneurial has a certain lift to it.
But this isn't enough to have the all clear yet. That's what I find interesting. You don't necessarily see some sort of resurgence in the KBW index on the heels of a positive story. People are looking for the negative news. They want the crisis. They don't want the sense of relief. And that I find interesting. I mean, there is a bias here to look for the bad news and then see the good news and shrug it off and say, just wait. And I think that that's a notable trend.
I expect that from a woman who, you know, the New York Mets have lost 6 out of the last 7 games. So, you know, I can understand the caution, the reticence.
Okay, go ahead. Where were you yesterday? Let's talk about it. How amazing your team is. How it was so much fun. Go for it.
The Red Sox, I enjoyed Boston yesterday, and thank you to the Boston Red Sox for really just very, it was actually very emotional. I was sort of shocked, you know, going back to my ute. But the answer is all that matters is they're doing better than the dreaded New York Yankees. Really, Lisa, nothing else matters. That's
this is somewhere where I can get on the same page with you on that one, just as a you know, Met sufferer. So there you go.
Headline: Bramo and Keene on the same page. It's just too much. It must be inflation Wednesday. Futures at -7. Stay with us for this important 8:30 report. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After making little progress on debt limit talks, President Biden and congressional leaders will head back to the drawing board on Friday for another meeting to try and avert a U.S. default. President Biden calls Tuesday's hour-long conversation productive, but House Speaker Kevin McCarthy said he didn't see any movement. The U.S. has announced a $1.2 billion package to bolster Ukraine's air defenses and ammunition stocks. The aid also includes satellite imagery services and equipment to integrate Western systems. The word came after Russia's President Vladimir Putin vowed to press on to victory in the war. Wages are rising fast across England and are finally catching up to inflation. Pay rose 10% in the past year for those taking new jobs. That's according to data posted to Reed Recruitment's platform. Figures point to a labor market that remains red hot. They cast double doubt on Prime Minister Rishi Sunak's vow to cut inflation in half this year. In China, Xi Jinping's latest crackdown is focused on experts hired by foreign hedge funds and CEOs. It's threatening the attempts of the government to lure foreign capital into an economy showing increasing signs of strain. On Tuesday, Chinese authorities targeted CapVision Pro, accusing the global expert network of leaking state secrets and being linked to foreign intelligence. And billionaire Steve Schwarzman has met with Florida Governor Ron DeSantis, but the meeting left him unconvinced of the Republicans' White House prospects. Bloomberg's learned that, for now, Schwarzman will hold off donating money to DeSantis. He's currently not supporting anyone in the Republican field. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Sometimes people get excited about the credit tightening. It's going to be a credit crunch. Not really. And the reason being, banks are in the business to lend, as we all know. And now they risk adjust that lending, and they may charge more for loans today, but they're not packing up their bags and not lending.
Gerard Cassidy's, what a great set we've had with the sell-side research here on this banking crisis with RBC Capital Markets. I keep wanting to say Tucker Anthony and R.L. Day, but that'll show my age, to say the least. Gerard Cassidy there on the banks this morning. Futures at -7, Dow futures at -52. Really waiting for an inflation report. Lisa, you know, we measure this, folks, by the red and green blinky of the screen. Like if I cross my eyes, you can get a feel for the market. There's nothing going on. We're just, that's all there is to it.
There have been some stories, some analysts coming out trying to project if it's above 5.9% year-over-year core, then you could get a 3% decline in stocks. And if it's below 5.2%, you look so impressed right now, we could get some sort of pop. But that's really where we are, which is the reason why you're seeing that blinky.
It's interesting to see. What we're going to do is continue this discussion right now and dive into it with someone with some real important finance background, including working in financial control at Morgan Stanley years ago. Christopher McGrady was at Villanova. He batted .364 his freshman year as he staggered up the infield to shortstop, and massive Northeast guidance, I should say, in baseball. Brought it over to securities research, and he joins us now, head of U.S. Bank Research at KBW. Okay, these banks are the New York Yankees. They're in last place. Everything's going wrong. You and your cohorts predicted, okay, it's all over with FRC. That's great. Now they're going to lift. And you're still in last place like the New York Yankees. When did the banks lift up to the extremes of the Tampa Bay Lightning? Tampa Bay Rays, I should say.
Let's check those stats on the batting average offline. I mean, right now the sentiment is just really terrible. You know, fundamentals came into the year pretty strong. But we knew earnings had peaked. And really what we've seen over the last 3 or 4 months is that acceleration to the downside of earnings estimates, and that's shaken investor confidence. And you've seen these 3 large bank failures really just shake confidence of investors.
The heart of Keefe, Bruyette & Woods, led by Thomas Schode, is just simple. You people have your ear to the banks like nobody else, with great credit to Sandler O'Neill, your arch competitors over the years. Great. What do these officers do to convey their exposure in commercial real estate? What does a CFO or a CEO do at 4,000 banks to say, hey, here's where we are in apartment buildings?
Sure. The numbers, we just saw the first quarter numbers. Numbers look great. Credit numbers look very strong. Now, the commercial real estate cycle will take time to play off. Everyone's concerned about office exposure. But generally, this is an asset class that's fairly manageable on these banks' balance sheets, 3%, 4%, 5%. So, yeah, there'll be losses, but the banks are coming in with a tremendous amount of pre-provision earnings power. So those losses will be offset. The banks will remain profitable. Dividends will be maintained. But certainly, this is another component of the bear thesis on the group.
Well, just to build on that, there's a feeling that because of a portfolio of assets that they can't sell without locking in losses now, they're constrained in the amount that they can lend. It wasn't really borne out in the recent SLOOS, the Senior Loan Officer Opinion Survey, but anecdotally, do you hear that they are tightening much more significantly and frankly, just much less willing to lend than they were even 3 months ago?
Yeah, they're being more selective, right? Interest rates have gone up dramatically, so the stress on there is stress on some of the borrowers. But regional banks are lending to their good customers. They're being more selective, right? The price of deposits has risen considerably over the last year, and the balance sheet liquidity situation is paramount. So they're being more selective, but they are lending. Loan growth has decelerated. It's gone from, call it 10% in 2021 to probably 3-4%. There's a downward bias to that. The Senior Loan Officer Survey, to your point, suggested that there's more deflationary pressures.
But do you really get the sense that anything could break the bearish sentiment at a time when this is no longer a question of deposit security and now a question of profitability that just seems completely hampered for the foreseeable future?
It's about confidence. Banking is about confidence, and right now the confidence is pretty low. The earnings estimates, we can deal with negative earnings revisions. We can deal with declining valuations, but right now we're talking about systemic risk, right? It's a very fragile system. There are some things that can be done. We can talk about the FDIC insurance coverage. We can talk about the Fed pause. Those will, I think, be important components to restoring confidence. But clearly, right now, it's pretty fragile.
So right now, we're getting some reports. Reuters reporting that U.S. prosecutors are looking into short seller activity in bank shares. Mm-hmm. Do you blame this?
I mean, short selling is an important part of efficient markets. We saw in 2008 they temporarily banned short selling that created a squeeze in some stocks, but ultimately it didn't solve the problem. We need full, free-flowing markets. But certainly there's been some unusual activity in some of the options that have been trading some of my companies last week. But certainly that's something we're going to look at.
I look at the technical damage, and I know you're not doing the technicals of the BKX index, and everyone watching this show, even internationally, sits on the Keefe, Bruyette, and Woods index is the benchmark. The damage is so great, we have to all adjust our x-axis to recovery. What's your x-axis, your timeline of recovery in this shattered index? Is it 2 quarters? Dare I say 2 years?
It's felt like a long time, but it's been 9 weeks since SVB. Last week we thought was going to be that T0 where post First Republic, that was an orderly resolution. We thought that would be kind of a catalyst to get back to normalcy.
That didn't happen.
Didn't happen. And I think what we saw this morning, First Citizens had good earnings. We've seen idiosyncratic companies like New York Community, these companies that are helping to solve some of the problems. Investors are hanging on to those stories, but it's going to take time.
Are you going to be out of a job in 5 years? How many banks do we go from 4,000 down to what?
Yeah, I hope not.
5 years out. I mean, seriously, do we go down to 3,500 or do we go down to 35?
I think it's somewhere in between. I mean, the math suggests you lose about 4% of the banks traditionally every year, so that's a couple hundred. Yeah. I would suggest that what's happened over the last 2 months is going to accelerate consolidation. Once you know what the rules are, and we're learning the rules from a regulatory perspective, that we need more banks, we need more regional banks to compete with the top 4. That should accelerate consolidation. But to your point, there are going to be fewer banks. The United States has the most banks in the entire world.
What will it take for sentiment to go up? What will it take for you to recommend all in that you actually see this as a screaming buy?
If we can get back to looking at these companies on fundamentals in the market, looking at fundamentals and not fear, that's the key to me.
So I'm in Washington. I'm walking down a sidewalk. A guy stops me, love your show, blah, blah, blah. You had the guy on from KBW, and you're talking about Middlebury and D1 hockey. Have you explained him or showed Middlebury needs D1 hockey like Villanova has D1 hockey? I mean, it's like a no-brainer, right?
It seems like
it's like un-American that Middlebury is in D1 hockey, right?
That's right.
Okay, there we go. You heard it from McGrady, Chris McGrady. Thank you so much for confirming that. He's with KBW in banking, and really thank our team for this terrific coverage you had from Ken Lyons and Ken Leon, I should say, and Gerard Cassidy and others. I mean, I agree. I thought there'd be a little bit of a recovery, and it was 4, 5, 6 days BKX.
People are looking for a boogeyman. That is what we have seen pretty much consistently. They're expecting something to break, and they're saying regionals is a place that it's going to happen.
Is it work from home?
It's just, you mean in terms of the boogeyman?
Just in general, yeah. I mean, we're back to 49% in New York City, I guess, of back to the office, but that doesn't help commercial real estate, does it?
You think that people are just sort of sitting at home and worrying and fretting. There are some of these monumental shifts in the economy that people can't get their hand around. And I think that with respect to regional banks, there is a question around profitability. There is a question about competitiveness with respect to getting deposits. It's just a ball of angst that's leading people without a sense of exactly what's under the hood, and frankly, a lack of confidence in regulators to really give a sense that they have a handle on this.
I'll go with the confidence, but I would also go to scale, this dreaded word scale, in that if we say each and every bank, except for the big ones, is going to be a smaller institution, you have to spread your technology expense, your labor expense, all the other, fixed costs that you have across a smaller banking platform. And I think that's hard. Let's do a brief here on inflation here at 8:30 this morning. Lisa's been looking at core and non-core, and there's a bit of a difference here. You're focused on core inflation at 8:30, aren't you?
Well, it increased month over month, the prior month. So do we see that kind of increase as well at a time when a lot of people are saying services sector side is just continuing to chart some pretty hot gains, particularly led by the airline sector?
You know what I'm going to look at?
You're going to look at Red Sox tickets.
No, real wages, 2 years, negative real wage. It has been 2 full years, this inflation report, that we have seen inflation-adjusted negative weekly earnings. I find that I can't even frame that, how painful that is.
This is the reason why inflation is the number one fight for the Federal Reserve, because it affects people and essentially it puts less money in people's pockets to get out there and actually live their lives.
Part of what we're going to do at 8:30, it's in 90 minutes, we'll do that with Michael McKee. The VIX exactly 18.00, 2-year yield 4.05%. That's a nice adjustment there over the last number of days. 2-10 spread, the vanilla spread, 55 basis points, not doing much. The real yield, 1.26%. Stay with us. This is Bloomberg Surveillance.
We have to remember, with rates being higher, it's more costly for people to borrow.
Our best guess continues to be that there are some earnings disappointments out there.
Part of the reason we have a challenge right now is the equity market is way ahead of itself.
It's one of those environments where the market is heavily biased towards pricing in a recession.
The consensus right now is expecting a recession to start really in this quarter. It just doesn't seem like that's going to happen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Inflation Wednesday. We're going to have that for you here in 1 hour and 30 minutes. Really nothing else matters. A report on the agony we've all faced in inflation. Services is goods. You know, we make jokes about it. We do our bow tie economic babble, the Bramah gloom. Every single viewer and listener has been slammed by this inflation.
And in specific pockets as well, especially if they want to travel, especially if they want to eat out, especially if they want to engage on any service level whatsoever. We talked with Elaine Becker yesterday about the airline industry. Double-digit increases 1 month after another in terms of how much those prices have gone up.
I mean, John has a Gulfstream, and so there I was, you know, at DCA trying to get back. And the 3 flights before mine, every seat was taken. Every single seat.
It's demand and it's supply. And you've been talking about this, and frankly, there are these distortions that continue to have some effect, which is...
in a lot of industries.
Right, in a lot of industries, particularly in some of the service side issues. How does this dovetail into a broader economic call? When you're pointing out, Tom, there are all these different inflationary data points that give the tea leaves to a very different narrative. How do you get a read on this one? And it's going to be under the hood, parsing out the details.
And even if we get a 7.1% service sector statistic today, a leveling of service sector, not a disinflation of service sector, the fear that's back there is what John Farrow's lived with his family in England or on the continent of Europe, what Maria Tadeo's living in Brussels, which is a substantially higher inflation. All of a sudden it's like, oops, are we a little bit like them?
Right. And
that's out there.
At this point, if you take a look at some of the market pricing, you don't see runaway inflation expectations. And this is giving the Fed some comfort to say, even yesterday we heard from Jefferson and Williams, basically inflation is starting to come down. That said, how quickly? Is it going to just naturally come down to something normal, or are we back to a normal that is a very different era?
I mentioned this at the end of the hour. Let's do it again. And what we do is we inflation adjust wages. And Lisa, there's lots of ways of looking at it. I do like the ECI statistics, which is wages and benefits. But under weekly earnings, which is something, you know, I like the weekly idea versus the hour to hour. 2 years of inflation adjusted wages that are down, they're negative, and that's the social cost of what we're looking at.
I'm glad you bring that up. We keep talking about the pernicious effects of higher unemployment, and that if that starts going, it will get going and it will leave a lot of people without a job. If we keep in this moment, this kind of inflationary environment, a lot of people are also experiencing real declines in their incomes, which has a real effect. So how do you parse this out? And that really is going to parse into the Fed call.
Wonderful guest here coming up. Mario Gabelli in the next hour is as well. We're going to get right to it with negative non-farm payrolls. First, a quick data check. Really quiet on the screen. Equities, futures, -7. The VIX, 17.98. I mentioned the lift in oil the last couple days, bouncing off 7.0 on West Texas Intermediate, 72.87. In the yield space, back above 4%, 4.05%, 2-year 3.50%, 10-year dollar not giving me much, euro moving away from the Bramah 110 to a weaker 109.52. We need a Wednesday brief.
It is 8:30 a.m. It is all about that figure that comes out in about 90 minutes time here in the U.S. The CPI report, we're going to be looking at core in particular, which has remained somewhat sticky. If it does come down, does it come down as much as people are expecting? Or does it stay sticky at a time of great uncertainty? And how does the banking story fit into that? We did just get First Citizens results. They came in well better than expected. But as we were just hearing from Chris McGrady, this is a specific story, not necessarily one that represents the broader sphere. And that's what you have seen with that KBW Regional Banking Index not recovering from the lowest level since the pandemic.
Off the pandemic, for those of you on radio, I mean, obviously down you go February of 2020, and you come up and you got a nice post-pandemic lift and then flatness. And I'm sorry, to me, that's the most emotional chart out there right now, how close we are to banking being priced at maximum pandemic fear.
And this is the main pushback against looking at backward-looking inflation reads as the current condition for credit, with a time when Torsten Slok of Apollo just put out a note about bank credit conditions at 2008 levels. Aftermarket Disney reporting and just getting a sense of the consumer spending, also with respect to just the streaming content versus the cable news, how they're doing on that, and then the experiences, which we know have been an incredible boom as everybody tries to get back and live.
Are you guys like riveted to Mandalorian?
No,
we're not. I mean, I'm trying. It's sort of like Succession. I hear from a lot of people, they're like, it's just not the same.
Well, we'll find out with the advertisement, et cetera. I'll be honest, I can't watch anything after a certain hour without falling asleep. Maybe I'm just revealing a little bit too much about myself and my schedule, but there we are.
Here's the banner, folks. Wait 10 years, Bramo. Joining us now, someone who's wide awake. David Kelly really made a splash the last time he was on with us. He's Chief Global Strategist, JP Morgan Asset Management. David, I've got to redo the stunning comment you made the last time you were on. You're looking for negative non-farm payroll statistics somewhere out there. After the jobs report, do you calibrate that we could actually see non-farm payrolls at some point give way to a negative statistic?
Oh yeah, I think that's coming. I mean, yes, it was a good headline number for the month of April, but they revised down the prior 2 months by 149,000. So if you look at it on a 3-month moving average, it's actually still falling. It's still fine at 220,000 right now, and that's because of a lot of pent-up demand for workers coming out of last year. But as this year goes on, as we go to August, September, October, I think the danger of a negative payroll read is high. And I think that will change people's perceptions on where the economy actually is.
The heritage of economics at the University College Dublin is to study like crazy the wage dynamics of the United Kingdom and Ireland through the Depression and on into the modern age. And the answer is all of it was accompanied by pressure on labor, pressure on wages, the labor share. When you see 2 years of a negative real wage, what is the cost of that to our listeners and viewers?
Well, it's significant, but I think we should look at this the other way around. You're talking about how services inflation is still high, core services. Well, core services is made up of really two things. It's all that owner's equivalent rent, which is kind of a mythical figure altogether, because it's the rent you would pay if you were renting, except in fact you own. And that's about 25% of CPI. And then you talked about airline fares, hotel rates, and yes, they're high. I mean, I experienced those in business travel, but to be honest, that's not the biggest problem for the average American. The average American, their biggest problem is food and energy. And of course, actual rents. Now, actual rents have stopped rising. Food and energy prices have stopped rising. They're high, but they've really stopped rising. So really what Americans in general need is a wage increase. So when I see the Federal Reserve all worried about, wage growth is too strong. No. You actually want wage growth to be a bit strong here to try and level the playing field a bit. So I don't think there's anything wrong with a little bit of wage growth here. What's really, what's unfortunate is that real wages are being pushed down because workers are actually pretty much on the defensive here.
David Kelly channeling the senator from Massachusetts. I believe I just observed that.
All things being equal, if people think that it's not necessarily the main driver of inflation, it should be a positive for the economy. But David, what would you have to see either in this report or elsewhere to change your view, which is right now what the market believes, that the Fed is going to turn around and cut rates because there is going to be this incredible disinflation?
It would take a lot to change my view, because we look at all the little pieces of inflation. We have to forecast this number, and it's a bear to forecast it. So we look at all the little pieces. And what we see is this pressure coming off energy prices globally, food price inflation in pipeline. I think it looks like disinflation. We're not, and we've got all these worries about potential recession, which I think is keeping down inflation elsewhere. So I see the economy gradually normalizing here. And our numbers say, okay, so today it's going to be about 5% year over year, not much change from last month. But a year ago in May, inflation was 0.9. In June was 1.2%. And when you back those numbers out, that means that the CPI headline inflation rate will be below 4% by June. We're pretty confident. We think it's going to be about a 3.8, 3.7 by June, and then it'll sort of flatline, and then it'll come down all the way through 2024 as shelter goes the other way. So we're modeling all the pieces of this, and it would take a lot and it's really been tracking very close to our models, throughout the last year, even though it peaked at a very high number. So it would take a lot to convince us that we're on the wrong path here.
The problem that I've faced, and please correct me if I'm wrong, when I feel like people don't have a sense and they're sort of throwing darts at a dartboard, because if you take a look at, for example, the Bloomberg U.S. Economic Surprise Index, it is at its highest level in more than a year. People have been getting wrong to the downside economic projections and have been surprised to the upside again and again and again. What's to say that's not suggesting that people aren't tracking the right things, that they're looking in the wrong places to really understand where the movement in this economy is?
Well, it is a complicated economy, and I think it's very wrong to use a rule book from the 1970s to try and figure out U.S. inflation dynamics. I think the story is completely different. One of the things that's been going on so far this spring is, first of all, we've got different seasonal patterns after the pandemic and because of sort of the evolution of the economy. I think that's helping payroll job growth early on in the year. We also saw big cost of living adjustments because of the lagged effect of that. That's all having an effect. Right. We've also got pent-up demand for autos, and that's having an effect. So I agree with the notion that we were not in recession in the first quarter. We're probably not going to be in recession in the second quarter. But we see plenty of reason to see downward momentum in the economy as the year goes on. And particularly, we're seeing downward momentum in underlying inflation dynamics.
David, I've literally got 20 seconds. On stagflation, you just don't buy it, do you? Stagflation is yesterday's story.
No, it sounds like a New York Daily News headline. I mean, it sounds scary, but the truth is it's really inflation stag. You get the inflation first, then the Federal Reserve overreacts, and you end up with stagnation. And what I'm worried about is that may be exactly where we're headed.
David Kelly, thank you so much. Greatly appreciate it. With J.P. Morgan Asset Management, really can't convey the value we've seen from Dr. Kelly here the last number of visits. You know, you put this view together. I'm not saying I agree with David Kelly, but boy, am I leaning forward listening when he talks about the vectors to negative non-farm payrolls, the vectors away from Larry Summers' stagflation to something way less inflationary, like Ed Hyman's talking about.
David Kelly is more consensus than a lot of people who are calling for inflation to be a lot stickier, which is more what the market is pricing in the David Kelly version of the world.
What will this conversation be? That inflation report near Labor Day. Stay with us. An inflation report at 8:30. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden and congressional Republicans made little progress toward averting a first ever U.S. default. They did agree on another meeting Friday, which will again include House Speaker Kevin McCarthy. The president said he viewed the meeting on raising the debt limit as productive. Bloomberg's learned New York Republican Congressman George Santos has been indicted on federal charges. He's been under investigation over possible campaign finance violations. Santos took office despite fabricating much of what he had claimed about his education and career. Former President Trump plans to appeal after a jury in New York found him liable for sexually assaulting a woman and then defaming her. It's the first verdict against him in a string of legal cases that threatened to erupt during the presidential campaign. The jury also ordered the former president to pay the woman, E. Jean Carroll, $5 million in damages. Jurors stopped short of finding him liable for rape. ECB President Christine Lagarde says the central bank's fight with inflation isn't over. In an interview with Japan's Nikkei newspaper, Lagarde said the ECB still has ground to cover. Most economists figure the ECB will raise its key interest rate twice more in June and July. Shares of Airbnb are falling. The vacation home rental company gave a cautious forecast for revenue in the second quarter. Airbnb suggested that rising prices and a murky economic outlook are starting to affect consumer appetite for trips. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Everybody in this meeting reiterated the positions they were at. I didn't see any new movement. The president said the staff should get back together. We explicitly asked Speaker McCarthy, would he take default off the table? He refused.
The United States is not going to default. It never has, and it never will.
I have been considering the 14th Amendment, but the problem is it would have to be litigated. And in the meantime, without an extension, it would still end up in the same place.
The great and worthy in Washington, an anticipated meeting of the President of the United States with legislatures yesterday over the debt and deficit of our nation. Pretty much on script. Lisa, do we agree on that? They just sort of pretty much went on script.
Everybody knew that there was going to be very little progress told outward. Some people saying it's progress that they came up with another meeting. They're meeting. That's what we know.
So what the value add is we can have another boring discussion on the debt and the deficit. As I said out on Twitter the other day, read Heilbronner and Bernstein from 40 years ago. They wrote the monograph on this of a linking of the capitalist system, and the debt was a constructive part of capitalism. But part of it, and over all of this, is maybe a morality on debt, which is a huge part of the national discussion or non-discussion. Romans, from the Bible, let no debt remain outstanding except the outstanding debt to love one another. Joining us now, French Hill of Arkansas. He is a Republican. Give me the morality here, Congressman Hill. It is a serious, serious issue no one's talking about. Is it immoral to have a debt and deficit in the United States?
I think it's, well, first of all, good morning to both of you. I missed Bible study this morning, so that was a great top of the show reminder. And let me say that it is immoral to have a debt and a deficit that are not controlled, and that's what we have now. We're running a forecast of over $1.5 trillion deficits a year for the next 10 years in the president's budget. That's the part that's unsustainable. You could argue that's immoral because it's substantially larger than we've run in the past, and it doesn't show the kind of discipline we should have to go back to a balanced budget and not be adding to the debt indiscriminately.
Congressman, there is a photograph of you and Bush the First in your youth, and that was back when we had commissions, I think of Greenspan and Social Security, that actually got something done. I'm still in disbelief that Simpson Bowles went down in flames. Why can't we be like any good democracy, get a commission to find an equal ground to do something about our debt and deficit?
Well, Tom, you're right, and I do support that idea. I thought that was one of the more effective things in the first term of President Reagan when he was cutting taxes and rebuilding defense. He also put Social Security on a stable ground by the Greenspan Commission, which had an up or down vote on how to do that. I would support a commission like that to tackle mandatory spending programs like Social Security, Medicare, make sure they have the stability and funding for the next generation, because they're 2/3 of our spending every year. They drive the deficit, which in turn obviously drives the debt.
Congressman, there's a really important conversation to be had about what's sustainable and good finance for this nation. There's another question around the manner to have it, whether we should be having it on a brink's edge, holding the U.S.'s credit rating hostage. Is this really the appropriate way to be discussing this at a time when both parties have increased the deficit?
Right. Well, I think that's why on February 1st, Kevin McCarthy met with the president and said, let's meet and have a sensible and responsible way to raise the debt ceiling and get spending under control following the pandemic. They had a meeting. The president promised to follow up, and 100 days have gone by. And what's happened in the interim is only one branch of government, one portion of a branch of government has taken action, and that's the House under Kevin McCarthy's leadership to raise the debt ceiling and propose some spending controls and regulatory policies that would make us have a better economy and a faster growing economy.
With all due respect, under former President Trump's administration, the deficit rose by $7.8 trillion. It brought it to World War II type financing conditions. And yet we didn't have a question over the debt ceiling. There wasn't this sort of pushback. We weren't brought to the brink. Why is it so different now that we can't have a discussion more clearly, even though we have the same kind of debt situation?
Well, I don't think that's true. First of all, the bulk of that spending was due to bipartisan spending to fight the pandemic, over $5 trillion. Shocking situation, shocking reaction by the Congress. If we knew what we know today, back in March of 2020, we probably wouldn't have spent that much money. But with that said, we did have a debt ceiling fight in 2019. And it was President Trump was forced to negotiate with Speaker Pelosi because he was not in control of the situation, the precise same situation that President Biden finds himself now. And that's why Kevin McCarthy went to the president on February 1st and said, let's do a sensible and responsible deal.
Congressman, what would your response be to President Trump if he did invoke the 14th Amendment to keep paying interest, to keep paying principal on the U.S. debt, even if we do go over that deadline with respect to this debt ceiling?
Well, Secretary Yellen doesn't believe that's a practical activity. I think it's sort of a gimmick. I understand the 14th Amendment, but we've also got legislation in the House that we've passed to continue spending the principal and interest payments on the Treasury and other mandatory spending programs as well. That was passed by the House Ways and Means Committee several weeks ago.
French Hill, September of 2015, Mr. Boehner fell on a sword and exited stage right, or maybe exited stage left, and that was the problem with the Tea Party at the time. Explain to me the challenges Kevin McCarthy has here not to do another John Boehner.
Well, look, I heard this morning earlier that people are concerned Kevin McCarthy only has one person can make a motion to vacate the chair. Well, every Speaker of the House, except for Nancy Pelosi, has faced the same procedural motion. It's not a new thing, and it can still be a motion that's tabled by 218 Republicans. So I don't view that as something that Kevin McCarthy is remotely concerned about. What he's concerned about is a responsible and sensible way of raising the debt ceiling and curtailing spending and going back to our pre-pandemic priorities.
Congressman Hill, what do you need from Secretary Yellen? What leadership can Janet Yellen provide in the coming days?
Excellent question, Tom. Janet Yellen could step in right now and say that she'll be happy to work with Speaker McCarthy and develop a responsible and sensible deal to raise the debt ceiling and curtail spending in the right way. And I think it would pass overwhelmingly in the House and Senate. President Biden could sign it into law well ahead of any deadline that she has set. And I would say, look, that's precisely what President Trump did with Speaker Pelosi. He asked Secretary Steve Mnuchin, then the Treasury Secretary, to get that deal done, and that's what happened back in 2019.
Congressman, thank you so much. The Republican
you
from
bet,
Little
Tom. Great
French
to be with
Hill,
you. Thank you, Lisa.
With us today in a terrific brief. Interesting there to see how the administration folds in here, and it's a different Secretary of Treasury. There's no question about it. This is not the usual corporate suit and tie. I say that with great respect for the people that have served over the years. This is someone that really understands the economic dynamics, particularly to labor, if we get a shutdown.
And speaking to the 14th Amendment and invoking that, she said that would create something of a constitutional crisis. That said, she is going to G7. She's going to meet with other leaders of the world's biggest economies and having to face off and basically say, yeah, we're a united nation with all of our past history and all of our current clout at a time when there is this huge question mark about whether we can even pay our bills technically under this.
Friday at 3 a.m., Bramwell and I will be the only ones awake to listen live to Anne-Marie Horton in Tokyo in conversation with the Secretary of Treasury. Looking forward to that. We'll bring you huge parts of that interview on Bloomberg Surveillance on Friday. Anne-Marie Horton in conversation with Janet Yellen for her balance of power and, of course, for all of the Bloomberg world. Look for that on Friday from the G7 meetings in Tokyo. We look to 1 hour now. 1 hour, 4 minutes away, an incredibly interesting inflation report. They all have been recently. And I'll tell you, if you give me a service sector chart nudging up, to me, that's the headline.
Yeah, well, I think that a lot of people are looking to see whether they see any of that nudginess and whether that's going to actually change the market's expectation for rate cuts later this year.
The futures -4, Dow futures at -53, the VIX under 18, exceptionally quiet, red and green blinking on the Bloomberg across equities, bonds, currencies, and commodities. This is Bloomberg Surveillance. Bloomberg Surveillance on radio, on television, as rumored. Thank you for being with us. John Ferro on assignment. He'll be back. When's he back?
He's back on Friday.
He's back on Friday. They're not. Oh, come on. They cannot give him Friday off so he can slide it into a sabbatical.
you can lobby on his behalf.
That's cruel and unusual punishment. We'll have to see what we can do about that. Ferro returns at some point, which will be good.
You kicking him out? Are you basically trying to say, don't come back? Is that what you're saying?
He's got to come back just to do Friday?
I'm not his
cruel,
booker or
unusual
agent.
punishment.
All right, carry on.
They wouldn't do that at Invesco. No way. Anyways, futures -6, Dow futures -65. I'm looking at the 2-year yield, 4.04%. I got nothing to say as we're 1 hour away exactly from this inflation report as well. Saving us today is Lisa Abramowicz with Market Movers.
Well, and this actually goes to the point that Bank of America pointed out, that people are actually going into specific stocks increasingly and moving away from indexes because they're giving you nothing, as you said, in terms of an edge or a sense of thing.
It's a huge deal. We're not going to take a ton of time here, but that observation is maybe the observation of the year.
Which is the reason why I love doing these movers every day, to take a look at what the underpinning stories are, because they're not necessarily industry stories all the time. Airbnb, a perfect example of that, shares lower by 14% after yesterday reporting earnings that disappointed, a sense that perhaps there was flagging appetite for going and traveling and staying in some of these Airbnb experiences. That said, beat expectations. So is this a willingness to travel thing, or is this a willingness to pay up to go to Airbnb versus a hotel room? I do think that there is a distinction
You're
there.
the expert at this. Come on, help me here. What's the trend here on Airbnb? Thumb up, thumb down.
Well, right now they're saying they gave an underwhelming second quarter revenue forecast. They said it was going to be a weaker consumer in terms of trips. They're going to try to diversify. I just think it's interesting. How much is this idiosyncratic? How much is this more of an industry story? Rivian rising almost 7% because they didn't lose as much money as expected. So it shows how low the bar has been there in the Tesla competitor. And Twilio shares plunging almost 17% after coming out with a weaker outlook as a software company. And what's interesting to me, again, people talking about how in tech there are these pockets of real good and then there are pockets of potential bad, especially if companies are not investing and pulling the trigger on some of these capital expenditures as they had been in the past.
Is that it? Those are all Dow Jones components that you've got there.
Would you like some more?
We're sort of. It's like the earnings season wrap up, isn't it?
Yes, because we're more than 90%.
Home Depot, May 16th.
Thank you. We're more than 90% the way through. I love this. You'll be like, is that it? Why don't you have Apple on there? And then normally you're like, well, why is everyone just focused on Apple? With a big bank?
I don't know. Those are the movers. Airbnb. I've never stayed in one of you.
Yes, of course. I used to all the time. And the big question is it worth it on a value proposition because of the amount of cleaning bills that you have to pay, et cetera?
The fees, et cetera.
The fees, exactly. And
up.
then, it's kind of like a question mark about what you exactly get and the booking time and dealing. So I don't know. I wonder how much people are moving back to hotels. I'm just speaking a little bit too personally. And by the way, JP Morgan shares lower by 0.3%. Exciting
Nailed
this
it.
morning.
There we go. Finally, an equity data check. In the world of debt, sitting there going, why am I putting up with this? Christina Kameny joins us now, Senior Debt Portfolio Manager, Global Debt at Invesco. Thank you so much for being with us.
Thank you for having me.
You're a grizzled pro. What's the duration you work at 24/7? Is it like 5 years, 7 years out? What's the duration in your head?
I feel like the 10 years always the default of what you think about, but I feel like in this environment, two's become so important with the Fed moving and what's going on.
So I got the wide inversion, 3 months, 10-year, with way over 3 standard deviations of inversion. What does a grizzled pro like you think of that, of what the signal of 3 months way tippy up here? Help me here. Get the camera up to grab my hand up here, because that's where the 3. There we go. There's the 3 months on radio. I'm not going to be able to move after this. And the 10 years way down here. Help me with this.
Look, the inversion of the curve, we're at historical extremes, and I think that's part of the reason that the market keeps coming back to we have to have this imminent recession. But that's also what the market has been calling for since the fall, that by second quarter, we'd be in a recession, all of these things. We've actually had a lot of the discussion on our team of how much is it a misguided signal right now because of the distortion of all the central bank buying of Treasury assets.
Can I rip up the script?
Yeah.
Giannakis over at Citigroup just threw in the towel today on a caution call in the United Kingdom. And he said, I think it was John Farrell sent him a note about the coronation and the importance of King Charles III. And so you got a King Charles III rally, stronger sterling, and that. Are we going to all throw in the towel on the recession call? Is that the surprise for the rest of the year?
I think people are dragging their feet on it and want to hold on to the narrative they have of the Fed is done and growth is slowing down. But I think you guys were talking about it earlier this morning too. The data has continued to beat and impress to the upside across the board. Inflation has been sticky. The labor market has been very strong. And I think the Fed struggles with this back and forth of, look, we're looking to slow down the market. And you have all of this noise that's been introduced in the last couple of months with the banking sector. But at the end of the day, we'll get some credit tightening as a result of that. But that adds to the Fed's goal, right? So then it's this, how do we materialize how quickly it comes? And
so we're 55 minutes away from the all-important data point of today, which is CPI. And I'm looking at core in particular to understand just the trajectory here. How vulnerable is this market to some sort of surprise amid a malaise of, I can pick my data point and I'm just going to go about my business?
I think the market is vulnerable. And I think, again, like we've seen the noise in the data, right? Like 1 month doesn't make a print. Like we had a 1 month 0.1 core print and like we're looking for back to like 0.4, 0.5. I don't think that there's enough consistency of the data or 1 month makes a trend. I think the market, both from in rates and in how you see Treasury's response, but also broader risk, is looking for weakness and looking for weakness of risk on the banking sector, looking for the slowdown, the recession to materialize, justification for the Fed to stop right away. I'm not sure if we get it right away, but I think like that's the way that the market is skewed in terms of reaction.
So I guess in terms of a catalyst for the next move, because that seems to be what people are waiting for, something to happen to actually make them have conviction one way or another. Where is the risk skewed? What is the bigger pain trade? That we end up with some sort of upside surprise or a downside surprise?
I think the pain trade is that you have continued stronger data and an upside surprise, and that you actually have some stability from the banking sector and growth.
Is credit the best place to be given the fact that you have credit spreads that could potentially tighten in that strength, even if there is some sort of sell-off in the benchmark rate?
So when we look across the board and we kind of think of three levers of rates, credit, FX, credit I think is the least compelling to us across those. And certainly like when we look global, so FX on a global basis probably is the most compelling. But if you just think about credit in the US, credit valuations are on the rich side. I think mortgages look more interesting than credit, than IG certainly. And I think it's a hard debate that people have of you want to rent the income in credit, but if and when things break, credit will break as well.
Well, you two are looking at the shorter term. I'm looking at the Bloomberg Total Return Corporate Index, the classic Lehman-Barclays series that Bloomberg has now and makes such good use of. And the fact is, as Bill Gross of PIMCO has said, we had a gift for years of price up, yield down. I mean, that's all there is to it. We've had almost 6 standard deviation move down off a 20-year trend. Right now, we're still down 15% from what we remember is normal. At Invesco, are you managing to get back to normal? Are you managing to get to some new total return regime?
I think it's a new normal. I think the environment has changed, right? Like we have a backdrop that central banks have massively inflated their balance sheets. They're looking to go the other way. I think we also have more policy volatility in the sense that all of these central banks have shifted to focusing only on concurrent data. At some point, they need to make the shift because they're waiting for these lags and it doesn't work. But I think it probably gives you more volatility of policy actions. And we haven't seen it, right? There's this big debate in the market, like, can the Fed pause and then hike again? Does that diminish their confidence? Yeah. But I think it means more volatility. And I think it's a different normal going forward.
What kind of total return do you get if we get one view that's out there of inflation here in I think it's 40 minutes? If we get a view from 5% down to 3%, dare I say we get a 2.XX handle on core or headline CPI, I believe it's, help me here, out of Villanova, price up, yield down, right? Did I get that right?
You did.
Is the thing we're going to miss here is the recovery in the bond market? That we're all just being way too cautious?
I think with the shift and what we're looking for from the inflation data, the market has given a lot of credence to the Fed in their credibility to bring inflation down. And even though we've continued to have inflation run where it is, you haven't really had market measures pricing it there. So on a kind of go forward basis, I think the Fed doesn't need us to be at 2.0 in inflation. They're confident with this move down, but sitting at 4 and 5 doesn't get it there for us, right?
Is this a fun market?
There are days that it's fun. I think like 25 basis point swings in twos every day gets a little.
Okay, no, but seriously, is it exhausting or is it actually like interesting and something that you could take advantage of?
I think it's interesting, and I think that there's opportunity to take advantage of, and especially in a world where you came out of fixed income was so dead for so long, and especially on a global basis. I mean, our portfolios are more global focused, and you've come from a 10-year period of U.S. exceptionalism that nobody cares about anything that's going on globally. So I think that's a really exciting story for us to tell of why EM, why global, why there are things going on outside of the U.S.
So in the equity space, not that you've ever looked at the equity space, there's single best buy. What's a single best buy in fixed income right now?
Again, I think when we look at those levers, FX and a broad dollar weaker trade, I think the dollar tends to trend in these 10-year cycles. I think EM, FX especially.
Can my Austrian 97-year piece ever come back? I bought it at 136.
It's good convexity to own, I think.
It's got convexity.
It's
you
good
see the convexity in my
own.
portfolio. My 401k is very convex right now after loading the boat on the Austrian. Price down, yield up. Laura, Christina, thank you so much. Christina Katmany with us with Invesco this morning. I love when she comes in because we just don't have these like thoughtful conversations about that's like, what's this spread doing? And, what's this, Brahma world?
I love the idea, too, about the bet on a weaker dollar, because that seems to be a theme that we've had more broadly. And it kind of goes into this question of what's behind that. Is this loss of the U.S. exceptionalism?
Dollar strength in the euro that Bramwell's watching, 110
like,
down to a
109.55
in 45 minutes, an inflation report. Vincent Reinhart at 8:30.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After making little progress on debt limit talks, President Biden and congressional leaders will head back to the drawing board on Friday for another meeting to try and avert a U.S. default. President Biden called Tuesday's hour-long conversation productive, but House Speaker Kevin McCarthy said he didn't see any movement. The U.S. has announced a $1.2 billion package to bolster Ukraine's air defense and ammunition stocks. The aid also includes satellite imagery services and equipment to integrate Western systems. The word came after Russia's President Vladimir Putin vowed to press on to victory in the war. Wages are rising fast across England and are finally catching up to inflation. Pay rose 10% in the past year for those taking new jobs. That's according to data posted on Reed Recruitment's platform. The figures point to a labor market that remains red hot. They cast doubt, though, on Prime Minister Rishi Sunak's vow to cut inflation in half this year. Electric vehicle maker Rivian reported a smaller than expected loss to start the year. The California-based company also reaffirmed its annual production plans. Rivian has been seen as a leading contender to break out of the pack of EV startups, but it's stumbled since going public in 2021 and has faced a number of challenges while trying to speed up production. And a dog named Buddy Holly was named Best in Show last night at the prestigious Westminster Kennel Club Dog Show in New York. Buddy Holly is a Petit Basset Griffon Vendéen, or PBGV for short. He's the first to breed to win the top prize. Some 2,500 dogs competed at that show. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Our thesis has been that, there are no companies that ultimately are immune from recession or significant economic slowing. And we don't think that this time ultimately will be different. Our best guess continues to be that there are some earnings disappointments out there.
Lisa Shallett, always interesting, Chief Investment Officer, Morgan Stanley Wealth Management. You dovetail that, folks, with the discussion here, the great divide between equities and bonds, and it gives you a reset, if you will, in the summer of 2000. 23. Excuse me, I'm gasping because I realize I've missed the last 6 episodes of Mandalorian. Futures -4, Dow futures -46. Lisa, we got to talk about this before we bring in Geetha. And it's just real simple. The last 10-year trailing, the Walt Disney and Company is 6.2% per year total return off of the ginormous success of Iger and the absolute collapse of this streaming. They're doing subpar single-digit work. They don't pay a dividend, 171,000 employees. And, you know, he's got to be going into meetings going, we're not going to do Mickey Mouse. Let's go. What are we going to do to fix it?
The difficulty is they've got such different businesses and levers that are pulling in different directions. You have the experiences that are doing really well. We all hear about that regularly.
Yeah.
If you know any Disney fans out there in Disney World and Disneyland. But there also is this question around, do they go with cable? What do they do with ESPN? How do they leverage their portfolio and address an older audience rather than, you know, just a sort of younger subset? And this was sort of like the babysitter for a lot of people.
It's a blue chip stock with $45 billion of long-term debt. It's a blue chip stock with 24% all-in debt. That doesn't sound like Apple or Amazon. Geetha Ranganathan joins us right now with Bloomberg Intelligence. Is this my father's, or for that matter, my youth's Disney? It seems like a changed company, Geetha.
It definitely does, Tom. And you bring up a really important point. I mean, if you just look at Disney's performance over the past 2.5 years, it's down 45% versus the S&P, which is up like 13%. So obviously a lot has happened over the past few years. Majority of that is tied to the streaming losses or the lack of streaming profitability. So really, I think Bob Iger's main agenda item is to communicate to investors and to the street how he is going to be able to turn the ship around and how he is going to get streaming to be a profitable business.
Christine McCarthy has been on the watch as CFO. What is she telling the guy who's Mr. Creative?
Yeah, so I mean, Bob Iger's return here has really been about aligning the creative and the financial aspects of the company. And I think he's going to do a really good job of that. You know, it's about building a robust content pipeline, but it's also about content costs rationalization. And they do have a $5.5 billion cost savings initiative that is right now underway. About $3 billion of that is content cost, $2.5 billion is non-content cost. So again, we're going to be really looking and listening hard to what they're saying in terms of profitability. Remember, this is a company that lost $4 billion last year on its streaming business. But the real investment case for Disney right now is the potential for fiscal 2025 earnings, when we think they can actually turn the ship around and generate $2 billion in profits. And so, you know, any color that Christine McCarthy or Bob Iger can offer today on the call, it's going to be all about that.
What will drive that profitability? Is it going to be simply a streamlined and frankly much smaller staff? They're going through a lot of these job cuts, thousands and thousands of them right now. Or is it going to be some property, some investment in the content that you expect to deliver some results?
Yeah, Lisa, that's a great question. I think it's a little bit of all of the above, if you will. So yes, the job cuts are going to help, but majority of their costs right now in that business is really content costs, is marketing costs, and they are kind of definitely reining all of that in. And then it's not just on the cost side, right? They are undertaking measures on the revenue side as well. So they have this new Disney Plus ad tier, which is definitely going to boost ARPU. And then remember, they had that 38% price increase that they implemented on Disney Plus just late last year. And if you kind of look at the Disney Plus ARPU versus, let's say, Netflix, I mean, it's a $6 ARPU versus $16 for Netflix. So do they have pricing power? Absolutely, I believe they do. This is a super fan product. This is a must-have product for any streaming fan, any Disney fan. So I think they have a lot more levers to pull in terms of increasing prices. So I think it's going to be a combination of all that, which is going to help to drive profits eventually.
What about ESPN? Is that still on the table as far as some kind of spinoff?
Yeah, so what is really interesting, Lisa, is that this time they're actually breaking out ESPN. For the first time in their history, they're breaking ESPN out into its own, division, if you will. I mean, that definitely clarifies, I think, a lot of the financials, a lot of the profitability metrics, because it's always kind of been obfuscated in that linear network business. Remember, this is, of course, this used to be the crown jewel and it's kind of now become this big pain point for Disney. but it still generates $4 billion in operating, income, and that's nothing to be laughed at. So I think really the big question is now, how do they make that bigger push into direct-to-consumer so that it's incremental and not cannibalistic to the ESPN business? So yes, a spin, a sale, anything, and any color that they can offer, again, I think will be looked at very closely.
Geetha, something that you guys excel at, Hulu, Disney Plus, ESPN Plus. Do we actually want Trio Premium? Is there a demand for Trio Premium at $19.99 a month?
That's a great question. There is a demand actually for a bundled product. And what we've seen with the bundle across the board is that not only does it help with customer acquisition, but it helps tremendously with customer retention. And so, for them, it's all about driving this bundle and kind of, getting that maximization of, engagement.
Right.
They are able to do that with the bundle.
Where's
Definitely.
the lines cross? How far out do the lines cross where Trio Premium takes over the business? Is that like a 3-year out glide path for Iger? Or is it, dare I say, 5 or even 10 years out?
No, I think we're definitely looking at that inflection happening sometime over the next year or so. But again, Tom, it all depends on what their strategy is going to be with Hulu. Are they going to hold on to the asset? They own about 2/3 of it. Are they going to hold on to the asset? Are they going to sell to Comcast? Iger has kind of spooked investors, I think, a little bit by saying, everything is out there on the table and that they're not really necessarily interested in general entertainment. So again, that leaves a lot of unanswered questions. So I think right now, top and center of everybody's mind is what is their strategy going to be with the Hulu asset?
Geetha, what a brief. Thank you so much. Geetha Ranganathan, truly expert on this with Bloomberg Intelligence. Paul Sweeney, who I enjoy doing radio with, Paul and Geetha invented this. I mean, this whole idea of just follow the industry, forget pretty much about buy, hold, sell, and just follow the industry. Do you have Trio Premium or bundled stuff? I don't.
I don't. No.
I don't.
I mean, I don't. I will say that what she was talking about in terms of pricing power, or that they have a product that people will be willing to pay for, is bearing some fruit. And we're seeing that increasingly in terms of people getting used to paying for content in a way that 5 years ago they weren't. New York Times actually just reported first quarter profit beating analysts' expectations, not because of advertising, because that actually declined, but what they saw was an increase in actual subscribers. People are getting used to this. Maybe it's just, Wordle that people want, the cooking
I will
section.
agree. Yeah, we're getting used to it. I will go with that. But it just seems like with the bundles, we're bundling ourselves back to where if any of us had the courage to add up per month what we're spending on all this stuff, is it any different from my cable TV bill of X number of years ago?
In some ways, it's more expensive, actually,
Yeah.
if you take a look at how much you're bundling and what the full year cost is. That said, people are able to choose what they want. And I think that is the distinction. And so if people want to see something, they will pay for it, especially without advertising. And that is something increasingly that a lot of these companies are exploiting. But I do think there is a shift in psychology from where we were a couple of years ago when people were just like, don't make me pay for what I could get for free, or trying to get, find hacks around the internet. You did that, right? Where you try to Google a phrase and then the cached version you could get for free, and then they turn that off.
Our guests that we have coming up here, we're going to sell you right now, folks. So if you have to lean with us into the 8 o'clock hour with Mario Gabelli, he's the CIO of Gabelli Funds. Lisa, this is a guy who's seen 6 revolutions. He was back when Sarnoff was starting off the, NBC and RCA and all that. And the basic idea here is Mario's a guy who's seen every technology come forward where, oops, you got to make a profit. And that's, oops, where we are right now with streaming.
Especially at a time where there definitely is a shakeout and the pressure of inflation. And suddenly content isn't king. We're also about a half an hour away from that key CPI Wednesday. It doesn't feel like CPI Wednesday. People don't seem that focused on it.
Because John's not here to cheerlead it forward. John would be all over this.
Well, we're trying. Other people are like, you can kind of make of it what you want.
I agree. There is some inflation analysis fatigue out there. It's like it's down. As David Kelly said, you know what? It's down from 9% to 5%. I don't hear anybody saying I feel better.
No, and everyone's, and people are like, just wait for another month. What's 1 month?
On radio, on television, why should you stay with us? Mario Gabelli, good morning.
If there's an accidental default, you will see a drop in stock prices, a drop in yields, and a widening of credit spreads.
We know the Fed's balance sheet has grown so dramatically.
If inflation continues to go up, we need to watch the bond market because long-term cash flows dislike inflation a lot.
There are no companies that ultimately are immune from recession or significant economic slowing.
Companies have been preparing now for several quarters for a recession that hasn't yet arrived.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is CPI Wednesday, 30 minutes away from that key inflation report in the world's largest economy. And does anyone care? Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Television. Tom Keene, Jonathan Ferro, Lisa Abramowicz. John is off today. And we are here awaiting that key CPI data as people try to reset, understand a catalyst for some sort of conviction in an otherwise convictionless market, Tom.
Yeah, Mario Gabelli coming up, too. We're going to get to him as soon as we can. Everybody leaning forward on the equity market and Mario Gabelli at 41.20. But I'm sorry, inflation front and center here today. It's an inflation that Mario Gabelli remembers 3 or 4 times in the past.
And it goes to the whole pricing power question. And when you talk about stock selection and stock picking, that is where people are going, because right now you cannot get a clean narrative on a macro sense. People will take a look at today's CPI report. Some people will shrug it off and say it's just 1 month and we will see people trade. But nonetheless, that stock picking really is gaining steam at a level that we haven't seen since the financial crisis.
And I would suggest in his youth, Mario Gabelli, as a young Turk, studied under the guidance of the value investor Philip Carre at Pioneer. And Mr. Carre said inflation is a bright light giving you a boosted revenue outlook that's always underestimated. Revenues do a little bit better.
A bright light that also sheds some information on who's the winner and who's the loser. And that, I think, will also be interesting to hear from him in terms of consolidation of market share at a time when you are seeing the bigger companies do better and the smaller companies do worse.
A headline coming out right now, this from the New York Post, and it's migrating out on Twitter as well. And this has to do with a gentleman on Long Island who's in a bit of difficulty, to say the least. George Santos, congressman of New York, now, quote, is expected to turn himself in today to surrender to authorities. And the judicial process is happening in the Eastern District of New York.
Yeah, he was indicted by U.S. attorneys yesterday. He is reportedly going to surrender. But the reason why it is interesting is also because of the small margin that Republicans have in the House, 5 seats, and he is one of them.
Yeah.
So there's a question, especially as we talk about the debt ceiling. Right now, in markets, we could see a little bit of softness here heading into, although honestly, are people doing anything right now?
No. It's a little bit tough. No, they're not. Which is good, because if Gabelli's on, he wants the full attention of what's out there. And so if it's this boring and this much of a snooze fest, it's a perfect time to talk to Mario Gabelli.
There we go. And that's the reason why people are looking at single stocks, because right now it's S&P futures 41.27 down, plunging 0.2%. That's where we're at.
The Euro report with Bramo 109.47, slightly weaker. I should point out there's a football match in Milan today. I don't think that has anything to do with. It's like following Elon Musk on Twitter. We follow the surveillance Gulf Stream, and it's got something to do with triangulation and John Ferro as well.
Subtle.
He is the ultimate bottoms-up investor. Mario Gabelli cut his teeth on machinery, things, as Gartman says, fall on your foot and hurt you. He is a sell-side analyst who's had a claim with a broader portfolio over the years in entertainment and such. Mario, I've got to go to, I couldn't do it as a diehard Red Sox fan. I'm not going to go long the Atlanta Braves. But this is textbook Gabelli. It was 20-something. Now it's on the edge of 40. Explain why the Atlanta Braves are going to win the Gabelli World Series this year.
I'm sorry about the Red Sox losing last night. The Braves are doing well. Independent of that, the pitch clock is having an impact on baseball by shortening it. We'll get the results over time. But in addition to that, you have other reasons for attendance. You have other reasons for revenues. There's about 62 million shares of BATRA and BATR, the lower voting stock. Our clients own a significant piece of the voting stock. And so as a result of that, we are obviously cheerleaders for the Atlanta Braves. And we think between Battery Park, that is the area in which the stadium is in.
Right.
The value of the franchise, I think you're going to get, $45 to $55 a share somewhere in the next 12 months.
Right.
That's it. It's and if you don't want to own it because you got emotional dynamics such as life, that's your portfolio. But give it to everybody listening. Should get 100 shares for Mother's Day for someone that they like.
Mario Gabelli on the Atlanta Braves putting me in the Gabelli it'll double timeout share as well. There will be reports on Disney, Mario. I think of you and Gordon Crawford at Capital Guardian Trust as being people that have followed this entertainment idiocy. Were you surprised at the streaming nonprofit, and is Disney the mother of all Gabelli values?
Well, you've got to look at the amount of money being spent on content by the companies. As an example, Disney will probably be 28 to 30 billion. Netflix is trying hard to get up to 13 or 14 or 15 billion. Paramount's higher than that. Then you have Apple trying to catch up, but Apple cumulatively, maybe for the last 5 years, has spent 13 billion. So they don't have any content. So where and how do you find, I Love Lucy and I Love Tom Keene and I Love Lisa? Those kind of contents are buried in there and they come back. And for example, A Beautiful Life with Jimmy Stewart, because of the bank run, people are going back and looking at that. So how important is the embedded value? When you do a theatrical box office, you had a $42 billion business. But the theater operators get 40% of that or higher. So now you go direct to streaming, and unfortunately, because of the regulatory organizations, the companies like AT&T and Verizon and T-Mobile don't get paid for people using the highways on a super speed. I go over to George Washington Bridge, and I pay less than a Class 8 truck.
Yeah.
So, Tom, from Disney's point of view, yes, you got a learning curve. You've got some dynamic short term. You want to go global. We can't be so. The U.S. has only got 350 million people. Right. The rest of the world has 7 billion more.
Right.
Plus.
Mari, are you still enthusiastic about Paramount? Do you still think that Apple's going to buy them?
My own reaction is that whatever. You have Bob Barski doing a great job running the business. You have good content. They're obviously making the tough decisions to give them financial flexibility. The Federal Trade Commission turned down an ability for them to monetize Simon & Schuster, what they're going to do. They're going to do BET. They're going to try to raise some capital there. But, from my point of view, a year or two from now, they have to sell or spin, which they've done before. They're very good. For example, nobody applauded them when they bought Pluto for as New Yorkers would say, bupkis, and they basically have done a great job on that. Now, independent of that, without getting into too much detail, they were spending $600 million a year on cash dividends. That's going to be down to, 20 cents times 650, a significant amount less. So over the next couple of years, put the foundations back in place, accelerate the growth, and execute. And that's what they're going to do. And then you ask the simple question.
Yeah.
If you got a stock selling at 30, which is now 19, let's call it 30, and you basically multiply that by 650 million shares, you're talking about a $20-odd billion equity value, and then you got debt will probably be down to $8 billion if they do the sale of these assets and keep the cash flow. So you're talking about a tiny little morsel. So if Sherry, who owns 30 of the 40 million voting shares, decides that, hey, Apple wants to pay me X dollars, and it's de minimis for them, and they don't have the broadcast stations anymore because they're spun out and they're in the process of spinning. Lovemaking takes place in a variety of ways.
So, Mario, on a broader level, you did just get back from Omaha, where you were at the Berkshire Hathaway annual meeting, shareholder meeting. Have you ever heard Warren Buffett this negative, this gloomy, this pessimistic on stock? Did you take a message from that you also adhere to?
I disagree with you completely. Warren Buffett basically pounded away at the idea that if you believe in the virtues of the American system that allowed him for 80 years, when he first started investing at the age of 13, to make a lot of money, that tailwind continues to flourish. So is he practical? Yeah. I mean, he's very patient. And so as a result of that, he's got his cash. He's waiting for it. All of us are going to focus on a 13F that's coming out by Monday and see what he bought, what he sold. Right. So what? He's got smart people working for him. And he first announced Greg Abel now taking over, and Ajit Jain continue to run the insurance business. So
Mario,
the management succession has been identified.
Everyone wants to know the value trap that's the banks. In your research note, you say to me that you want to buy a Southern bank for acquisition. My theme for the year is the great zombie roll-up. Are the smaller banks one collective zombie, and are we going to see a massive bank roll-up led by banks in the South?
Look, you got all of the right dynamics. We have a lot of banks, but let's flash back. You and I have been doing this for a few years. You had a crisis in 1967, 8, 9, where the banks lent money to oil tankers or whatever they were. In the 70s, you had the Herstatt Bank, you had the whole bunch kind of go bust. You had a whole, in the 80s, you started 1,000 banks, Tom, went bust in the Savings and Loan Association crisis. Because of that, the accountants put in a rule called hold to maturity, don't amortize, and then you had no interest rates for an extended period of time. So somebody says, I got a deposit, I'm going to lend it long, it costs me no money. The basic bank problem is you borrow short and lend long, you got a problem. Independent of that, you still need to have that service for the American public, the American economy, and we'll get over this notion of how bad the office markets are. That's it.
Mario, we got one Yankees fan. He's down in Florida, and this Yankees fan emails in and says, the breadth of the market is important. Broad-based rallies have the potential to continue, while narrowing rallies are prone to failure, quoting the great Bob Farrell of Merrill Lynch years ago. Have you ever seen anything as narrow as what we see with Apple Computer and 4 other stocks, and what do we do about it?
Well, you got a lot of dynamics. If I was growing up, Tom, playing World of Warcraft, and I'm now playing Diablo 4 on my machines, I am very quick. I learn. I want instant results. I want to play momentum. Clearly, and then I get on Robinhood, and then you get quants, Momo, algos, and AI all coming together to do trading. The markets are the markets, okay? The values are the values. Over the next, right now, for example, even if GDP is down 2% real, and inflation's 5%, you're going to get nominal revenues growing at 3%. And that's a large basket for what you talked about before on your show. If companies having gross margins, SG&A, they're learning how to deal manufacturing, reshoring to the United States. Kaizen is out. That is the just-in-time inventory. Now you bring it closer and you get more efficient and you do AI and you start doing a lot of automation and you pray for immigration because that's where the long-term growth of this country is coming from.
Mario, we've talked about how we are seeing an increasing number of people go back to stock picking from just simply indexing. Do you notice that in the day-to-day? Do you notice more people interested in the trade that you've always practiced and you continue doing so?
No, but go back one giant step. I come from a culture where we had Graham Dodd, Roger Murray, Bruce Greenwald, and now Talos Santos teaching value investing. How do you do research? What is the value of an enterprise? Who is going to buy it? What would private equity pay? What is the capital structure that they can tolerate? What is the tax structure? How good is it? And then you cut through all the crap.
Right.
Stuff. How good is the business? How good is the management?
Right.
And the values that you're buying them at, are they well below what you think the intrinsic value is? And therefore, that discount, will go up and down. Over time, you're going to do okay. I think that the market, Tom, in 45 years will be 1 million on the Dow. So, that's 7-8% returns.
Mario, but you're showing your cards here. You're showing your Morningside Heights cards here. And the bottom line is Columbia Business School, and you mentioned Grab, Dodd, and Coddle, and a guy named Buffet went there years ago as well. Do the young Turks of Columbia Business School believe in the traditional Warren Buffett securities analysis?
There's a lot of cultures that come in quotes, in the financial area. You want to integrate analytics. Tom, if you and I were around 200 years ago, what we would be talking about today on this show was that the Rothschilds got a pigeon to tell them who won the battle at Waterloo and that they went down and did something on the stock market. We can talk about that another time. Then you used to have Warren Buffett go down in Washington, D.C. to microfiche data, or Graham. I did it at the New York Stock Exchange. Today, I gave a speech and I said, Chat GPT. I got my grandson to do it. And it was a brilliant speech. And it took him 5 seconds.
Yeah.
So the question is, how quickly can we gather data? How quickly can we use it? But then when you got to be some practical judgment has to go in the mix.
Murray, one more question. Speak to the people out there that want to be in the market, but they're scared stiff. How do you play? How do you participate?
Well, first of all, you got to do what Buffett says, which is patience, long term. Don't worry about the short term dynamics. If I own a farm out in Iowa or in the Bronx, my farm in the Bronx, I'm not going to wake up every day and figure out what the prices are. I'm going to look at it and say, what are my cash flows, or what are my predictability, and what can I harvest it? Same thing with good businesses. If you buy a good bunch of business, and whether I have like the Tegna, Taxtron, Trayton, Televisa, my T's, we can talk about these things. The stocks will go down, they'll go up. But, 5 years from now, I'm going to make it 10, 12% CAGRs.
This has been brilliant. Mario Gabelli, thank you so much for particularly there on banks in the South as well. What did you learn there, Lisa? That was a tour de force.
Well, just the difficulty in really doing the discipline that he was talking about. Doing the work. And
That's
understanding
Mario Gabelli 101, yeah.
how to do that research. I do think that some of the edge that people are looking at is investigative journalism in a way, is to dig into some of these companies, the streamlines, to understand exactly the dynamics that perhaps other people might be missing.
It's going to be interesting to see, and as he talks there about making, the discipline of 7-8% per year in equities, and a lot of people have a long-term time frame of maybe Friday when Ferro comes back, or maybe Wednesday of next week is really long-term.
Well, and in the meantime, what we do have, we are about, 13 minutes away from the CPI report. And just giving you a sense, we are expecting 5% year-over-year CPI. That's the headline figure. We are expecting with core, and I keep going back to this because perhaps it strips out the more volatile energy and food sectors, 5.5% down from 5.6% in the prior month on a year-over-year basis. Do we see this come in hotter than expected? That a lot of people are saying, just to game it out, a lot of people in the market are saying that could be a pretty significant catalyst at a time when people have discounted inflation coming back up and said, okay, we're already in this disinflationary kind of realm.
And as David Kelly said, it's a lagging indicator, and he's already framing out 3% or even sub 3% inflation. I think Ed Hyman of Evercore ISI and others got there. David Rosenberg got there very, very quickly, and that's out there. Forget about it. In Washington, all they're hearing about, even off of a gallon of gas maybe being a little bit better, and even with real estate and the reports, rents are coming in around the country, not in New York City. Folks, you know what? 5% is just totally unacceptable.
Especially at a time when you do have a concern about negative real wages, as you were pointing out. We also talk about what drove this inflation, and a lot of people pinpoint spending, which is one of the reasons why it's that much more salient that we're having the debt ceiling debate again and again, and right now in a more poignant way perhaps than we have in the past. Joining us now, Henrietta Trace, Economic Policy Research Director at Veda Partners. Really appreciate you joining us. Henrietta, your take on the non-action, the non-development of yesterday's meeting, and whether any of these meetings will really yield any fruit until, as someone said yesterday, the 11th hour, the 59th minute, and the 59th second.
Yeah, that's exactly right. I mean, anybody who's been through this movie before knows that they do not get anything done until they have to. In DC, we are functionally 4 weeks away from June 1st, which even Treasury has not been hard and fast on the actual deadline. The House has been out of session for about 10 days since their vote a few weeks back. So when they had the meeting yesterday, my base case assumption, and from speaking with staff, was that nothing was going to come of it. There was going to be press availability. They were going to shake hands, get a lot of, jabs in, which we obviously saw from Speaker McCarthy, sometimes a little bit more aggressively than anybody would have anticipated in an ordinary year. But he's really proving what he wants to be and present as Speaker. And so this was much more about posturing. You'll notice that the biggest takeaway was that staff is going to get involved now. That's all I want as a former staffer, is to get staff involved. They'll start meeting today at the leadership level. One of the areas of concern I hear most is, hey, the House and Senate are not going to be in session at the same time for the next consecutive 3 weeks. Are you concerned? And my answer is no. I don't care what rank and file members are doing. I really only care what staff is doing, and they will be meeting tonight. They are free to work through the weekend. They do not need to attend every single fundraiser back in the district the way that members do. So there really are 3 full weeks to get a resolution here. And the way that I would phrase it just briefly, a good rule of thumb here is look at the Thursdays for the rest of May. Thursday of this week, we start to get action out of staff. Thursday of next week is the earliest I would expect a Senate vote, and then Thursday of the following week is when I would expect a House vote. So that's plenty of time.
This is like waiting for smoke signals, right? Wait for Thursday, and we can get some sort of sense of what's going on.
It's very Apple. You know, I agree.
Yeah, Pastor Keene over here this morning. Henrietta, I am curious about this George Santos development and how it relates to some of the close margins that Kevin McCarthy is working with. The New York Post is reporting that GOP Representative George Santos is going to surrender after the indictment that we heard about yesterday. He does plan to turn himself in, according to this report. This highlights that Kevin McCarthy is working with a 5 Republican margin of error that he has to keep on the rails. Does this change the equation at all in your view?
I mean, it really underscores the current equation. This is an empty shirt that you're trotting around that has no committee assignments and is only there to vote the way that Kevin McCarthy tells him to vote. When we were dealing with the Limit, Save, Grow Act initially, I thought it was great when Santos came out and said he didn't know which way he was going to vote. He's going to vote whichever way Kevin McCarthy tells him to vote, and that is the requirement in order for him to stay in Congress. So I think this just underscores how razor thin, as you point out, the margins are for Speaker McCarthy, that you would keep someone like George Santos in there, that the rest of the caucus has to explain away. And that's a tricky thing for them to do.
Why can't we get to a commission? Simpson Bowles or some flavor of that. Is it, Henrietta, you're expert at this. Is it so fractured we can't even get to a commission because these clowns are afraid of the outcome of a commission?
I mean, give it time. Alan Simpson is an all-time rock star as far as I'm concerned. Those were great days when we had the Simpson Bowles Commission. We even had the Super Committee at around that time, if you'll remember that group of people. So to get a serious answer, when I started out yesterday, I assumed that there would not be any breakthroughs in negotiations at the White House. So my immediate next step was to listen for any dog whistles for a fiscal year 2024 appropriations process, discussions of the budget, discussions of actual government spending in those 12 approps bills. That is something that I spent my time with staff collecting thoughts on, hey, what are the odds we kick the can down the road, just get a short-term suspension going from June 1st to September 30th, which is the end of the fiscal year, and see what the odds are and whether they're rising for that sort of 4-month bridge period. That 4-month bridge period is when you'd see Simpson Bowles or Super Committee start to form.
Yeah, you've teed up the can like Lucy with Charlie Brown. I mean, I know the way this goes. What happens the first week of October if we moveth the can to September 30?
Exactly. So this is my worst case scenario and has been since January, this situation where we never reach a conclusion. Why? Because, we only have 4-vote margin in the House and a Democratic Senate. What you start seeing there and the risk is that we only do these short-term punts and this sword is hanging over us for the next 2 years. That's, in my opinion, a very bad outcome. And that could very easily pass. It happened in 2021. We had always the federal fiscal year ends on September 30th, but at the time we couldn't agree on the appropriations bills either. So we passed a 3-month extension of those called a continuing resolution into December 3rd. And then we simultaneously bumped the debt ceiling out that same exact period. It was a $480 billion suspension specifically designed to get the debt ceiling to coincide with the CR expiration, which of course had been punted from September. So that's a very real risk.
Yeah, Henrietta Trace, thank you so much. She is chairman of the Alan Simpson fan club in Washington, with Veda Partners as well. With Senator Simpson, every time you interview him, it's a risk because you have no idea what Alan Simpson is going to say.
Sometimes
you have no
like
idea
this
what's
show,
going
to.
He's wonderful. I mean, it's really a throwback to a different time and place where these people weren't, managed and choreographed, and that's part of speaking with Congressman Hill of Arkansas. He's removed from the modern choreography of the politicians.
Well, the curiosity for me today is what the choreography of the inflation report's going to be in terms of both how we get the numbers, what the response will be in markets, and then what the political response will be, given the fact that this is a visceral type of number that you spoke about, with the real wages being deeply negative for another year. This really coming at a time when a lot of people think that the balance of risk seems to be more heavily weighted on cutting too much, even though the inflation is still perhaps a little bit higher.
The Bloomberg surveillance cliche is to look at headline, look at core, and then we go beneath the headline numbers. And quite frankly, Lisa, inflation more than the jobs report is going beneath the headline numbers. And what I'm really looking forward to talking to Mike McKee about not only at 8:32 when he's buried, but 3 hours on, or frankly 3 days on, is the dynamics Mike McKee sees in real estate within the service sector component.
On real estate, on autos, I mean, the specific subsectors, you see all of these analyses about how auto prices really have been whipsawed and how they went back up in used car prices and then they came back down, and how much this might really underpin a lot of the CPI movements. But yes, people are getting granular at a time where there's such noise. I mean, this is such an uncertain moment to really gauge out some of these basic metrics, and we heard that earlier this morning as well from people saying you can pick your spot.
Headline inflation, core inflation, Cleveland inflation, Dallas inflation. They're all out there. I think there's Upper West Side inflation too.
That's a special one.
That's a special one as well. We're going to have this for you here in 4 minutes. Please stay with us. Always moving the markets in perspective from Andrew Hollenhorst in the next hour. This is Bloomberg. Stay with us. Inflation in America. It has been the story of the Biden stimulus, the pandemic. It has killed everyone. There's no other way to put it. 22 years, rather, of negative wage growth. And we will get statistics here in a moment, a new reset on inflation, and a new wide debate on the path forward for the price change you're facing every day. Lisa Abramowicz and Tom Keene here on a day of inflation, goods, services. And the good news is we have Michael McKee to assist forward. Michael, these seem to be challenging statistics. Give us
they're what you'd call in line. It looks like economists did a pretty good job of forecasting CPI as the month-over-month change for both the headline and the core comes in exactly as forecast at 0.4%. Now, that's up on a headline basis over what we saw last month, which was a 0.1% increase. We're looking for any kind of revision to that. On a month-over-month, year-over-year basis, rather, 4.9% for the headline, which is a little bit below the 5% that was expected and 5% we saw last month. 5.5% as expected for the core year over year, and real average weekly earnings and average hourly earnings both negative, down 1.1% for weekly and 0.5% for hourly. No surprise there, Tom. You mentioned right before we went on that we'd see negative wage growth, and we're still seeing that.
It is a shift here, to say the least. Like 10 basis points in the 2-year yield. If you're not part of Global Wall Street, the operative word is ginormous. The 2-year yield from a 404 down to 3.96. The 10-year comes in 5 basis points as well. And the Bramo bull market is intact here with an equity lift of futures green, and they go up on a nice. Lisa, what do you think? On a nice level, they go up, a little green in the screen.
Well, here's the question that I have. Was the whisper number just basically a much hotter inflation read? Was this basically taking the tail risk of a reaccelerating inflation, taking that off the table? Is that the sort of relief trade that we're seeing in 2-year yields in particular? Or is there something in some of the subcomponents that's getting people's attention, the super core, that's getting people's attention?
Yeah, I don't mean to interrupt, but I'm looking over at McKee. He's got the secret sauce here, the mythical secret sauce. And Lisa, it's like 20 lines of data. What are you looking at there, Michael?
Well, here's what moved during the month. No surprise, energy was up quite a bit by, for gasoline, 3% during the month. So that is a significant increase, but that goes into the headline. Less concerned for the Fed. Natural gas, significant decline there, down 4.9%. People have been looking at that as something of an energy relief. And then the cars, used cars up 4.4%. They were down 0.9 last month, and they had been down for about 6 months before that. So 9 months, I think, is the total. So anyway, a big rebound in used cars helping push things up, and apparel up 0.3 on the month. Medical care commodities up 0.5%. So a lot of these were forecast by economists going into this, and it looks like CPI is coming in pretty much as expected. And it's important to note that the Fed has always said they would expect a volatile process of inflation coming down, that it wouldn't be linear.
Yeah.
And we would see bounces, and that's what we seem to be seeing here.
Lisa, I'm hearing as expected, but markets aren't telling me that. Markets are moving.
That's exactly what I was going to go to. And Ira Jersey of Bloomberg Intelligence put this out, that CPI has been among the most market-moving data points in the past year or so. So this actually explains that, even though we're not necessarily getting the why from the actual data. Mike, is there something that we're missing, the why, that's causing the market-moving event of today?
I'm not seeing anything that stands out as something that we did not expect. I think what you have is a market that is attuned to you have people basically looking for the Fed to, in July, start cutting interest rates. And so everybody's repricing off of that at the moment, but it'll take a while for them to kind of figure out where we go from here. The initial knee-jerk reaction is something that we don't necessarily need to follow through on. Airfares, good news, though, down 2.6%.
I feel bad.
There's a surprise. Yeah. So, Tom, on your next vacation, you'll be able to spend a little bit less money.
50 lines, 100 lines of data. Michael, he's looking at that. He'll have that into radio and television in the 9 o'clock hour as well. We're thrilled to bring in a gentleman that can really bring in the perspective here and the relative sense of this inflation to decades previous. Vincent Reinhart joins us this morning, working with Chairman Greenspan for years, chief economist at Dreyfus and Mellon, and we're thrilled he could come in here with a big move in the 2-year yield. Have we tamed inflation, Vincent Reinhart? Can we say the path here, that there's a confidence to get back under 3% inflation?
Not particularly. Service inflation still had a good bit of momentum. But as to Lisa's question about the why, I think the why is the headline. Inexplicably, or by rounding, 12-month headline CPI is 4.9%. I view that as the chief talking point for politicians, that inflation has dipped below 5%.
Vince Reinhart, we're going to go to Mike McKee, who's just found the one data point to help Dreyfus Mellon right now. What do you got, Mike?
Well, this may have influenced trading, and I've also got a note from somebody who's watching us who wondered why I didn't say this before, and it's my omission. Owner's equivalent rent up 0.5%, and rent of shelter up 0.5%. Rent of primary residence up 0.6. So we're still seeing a lot of pressure in the real estate side of this, and that has not started to go down, and people had thought we might see some relief. We did last month, but not this month.
Vince, this is the granularity of Alan Greenspan. Look at each and every data. Is there an efficacy to look at real estate data, OER or otherwise?
The problem with that is there's a lot of data. And indeed, one reason the market might take good news out of shelter inflation, providing a good bit of upside to overall inflation, is Chair Powell has indicated that the forward-looking indicators of shelter prices that he looks at suggest there's going to be good news soon. The problem is once you delve up into the details, you might get trapped in the seaweed.
So trapped in the seaweed, and yet this is sort of the seaweed that Jay Powell himself has sent us to. And Mike was just talking about the core services ex-housing as the seaweed that the Fed is saying that they're going to hinge their inflation outlook on, and people pointing out that fell to less than 5.2% on a year-over-year basis from 5.7% in the prior month. Taking a look at that type of cooling might give the Fed some encouragement to move away from some of the more aggressive rate hiking, or at least rate stabilizing projections that a lot of people had. Do you think that that's enough, Vincent, or do you think that this is perhaps a head fake?
I think it's a head fake. I think that you have it right, that the chair does slice and dice the data because he wants to get the slightly more than half consumer price basket that he thinks has a lot of momentum. Services, less shelter, still has momentum. That the shelter inflation is projected to continue to soften. That will be good news, but it doesn't change the core problem. There's some momentum there. The core question to ask, sorry to use that part, is, was today's print disqualifying for Fed action in June? I think the answer is no.
So you think that the bar, Vincent, this is important. You think that the bar is more heavily weighted to fighting inflation still, even though a lot of people think that the bar is now in preserving financial stability and perhaps preserving employment. You think that people have that wrong?
I think the bar is about stopping, because once they stop, once they go a meeting without policy action, everybody is going to assume that the Federal Reserve has drawn a line under this policy firming cycle. And so you better be sure that when you stop, you're not going to look back at regret, just a couple months later. Remember, they slowed a little early in January relative to what, in retrospect, they think they should have done. They're having flashbacks to that right now.
What will you say then to people who say that this is evidence of the disinflation? This is another sign that it is naturally happening, especially as you see almost downright disinflation in certain goods. How do you push back against this in a longer term trajectory and say, no, you're wrong, this is more akin to the 1970s?
I agree absolutely that it is a sign of disinflation. It's a sign of a little bit of disinflation, but when you start very high above goal, it's a long process. The Fed will take this as encouragement. They should. Inflation is headed back to goal, but they have to be confident that it's headed back to 2%. And this is just another drop in the ocean.
We continue with Vincent Reinhardt of Dreyfus and Mellon this day of important inflation data moving the markets here. We looked at the 2-year yield with a huge 10 basis point swing, a 405 back under 4%, 395 on the 2-year yield. Lisa, I've underplayed equities here. My fault there. Futures up 15, 41.49. I mean, I want a 41.50 print so I can round it up to 4,200. But I'm sorry here. We've got a nice little lift in the equity market. It's a stock market that just won't go down.
This idea that if the Fed doesn't raise rates more or even cuts them, it will be positive. Vincent, just quickly, do we have a sense here that if the Fed does sort of pull back, that will be a good thing and will allow growth to kind of persist?
It will support economic activity. It may not be a good thing over the medium term, because if they regret it, the worst thing that can happen to markets is the Fed having to tighten sometime later this year after having stopped.
Vince Reinhardt, thank you so much. With Dreyfus and Mellon, Michael McKee on page 42 of the report. Quickly,
well,
Mike,
we've got the core services ex-housing number, which everybody is interested in. It does go down to 0.27 from 2.9 on a month-over-month basis, and down to 5.16% from 5.73%. Small, but some progress.
But that vector of service disinflation is still in place, albeit barely sloped.
But barely sloped.
There?
That's a good way of putting it. I was looking at the chart, and that's a good way of putting it.
How volatile has
you
this
got
been?
the sound effects for the inflation report.
It sounds like a UFO. I am curious, though, about whether we have seen that incredible volatility that people are talking about.
Well, we have seen it in the month-over-month numbers here, but we're seeing in this core ex-housing, we've gone from 5.73 last month to 5.16. So you're looking at a 60 basis point move almost.
Yeah. All right. Well, we'll continue this conversation with Mike and with others coming up in the open. Andrew Hollenhorst of Citigroup joining, Eric Knudsen of Neuberger Berman, and Liz Young of SoFi. Also, Alexander Yoakum of CFRA on the other storyline, which is the regional banks.
Liz Young has been on fire on Twitter.
Yeah.
Really informative.
Very much so.
Stream or whatever you call it.
How do we get some sense of how we move forward from CPI Wednesday? This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After making little progress on debt limit talks, President Biden and congressional leaders will head back to the drawing board on Friday for another meeting to try and avert a U.S. default. President Biden called Tuesday's hour-long conversation productive, but House Speaker Kevin McCarthy said he didn't see any movement. The U.S. has announced a $1.2 billion package to bolster Ukraine's air defenses and ammunition stocks. The aid also includes satellite imagery services and equipment to integrate Western systems. The word came after Russia's President Vladimir Putin vowed to press on to victory in the war. Wages are rising fast across England and are finally catching up to inflation. Pay rose 10% in the past year for those taking new jobs. That's according to data posted on Reed Recruitment's platform. The figures point to a labor market that remains red hot. They cast doubt on Prime Minister Rishi Sunak's vow to cut inflation in half this year. In Pakistan, former Prime Minister Imran Khan will be in custody of the country's graft agency for 8 days. Now, that comes after his dramatic arrest on Tuesday, an event that triggered violent clashes across the country. It marked a sharp escalation in Khan's confrontation with Prime Minister Shehbaz Sharif's government and Pakistan's powerful military. And there's a sign that housing demand in the U.S. is starting to find its footing. Mortgage applications rose last week as borrowing costs ease. According to the Mortgage Bankers Association, applications for home purchases rose 4.8% last week to a one-month high. Meanwhile, the contract rate on a 30-year fixed mortgage, that ticked down 2 basis points to 6.48%. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
I will be particularly focused on assessing the evolution of credit conditions and their effects on the outlook for growth, employment, and inflation. We're going to get a lot of data between now and our June meeting.
Good morning, everyone. John Williams, the New York Fed president, there now, and speaking on the changes before this inflation report. Your headline, as the market day opens here in 45 minutes, is simple. Inflation has moved the markets and continues to move the markets in the last 10 minutes. I'm using the 2-year yield as a barometer, 4.05%. Down we go 10 points to 3.95%, and we move even lower. Note price higher, yield lower to 3.94%, a substantial move. I'm going to call that 14, 15 basis points in the 2-year yield. The NASDAQ 100 up 0.8%. S&P futures put it on, up 28 points right now, 4162. Joining me as head of all of our economic coverage, Michael McKee is with us. He's experienced at talking with Fed governors and Fed presidents and really has trouble with former Fed presidents because they're afraid of him. William Dudley joining us now, the former New York Fed president and Bloomberg opinion columnist. Bill, I got 8 ways to go here. I'll stay on script on inflation, and McKee, I'm sure, will have smarter things to say. 5% is flat out not acceptable. Everyone understands that. What inflation rate is that moment where Bill Dudley relaxes?
I think when the Fed gets the inflation rate down into the 2s and there's more slack in the labor market and wages are rising more like 3 to 4% rather than 5 to 6%, which they're doing now. You know, the Fed's making some progress on the inflation front, but they haven't made much progress yet on the labor market and on the wage trend. So it's hard to see inflation going all the way back to 2% with a labor market this tight and wages this high.
In your studies at Berkeley, is it necessary to have unemployment go up to bring inflation down? Why can't we just move the inflation needle, the disinflation needle, and keep America employed?
Well, that would be the ideal outcome. It'd be great if we could operate at a 3.4% unemployment rate with 2% inflation. But historically, that suggests that has not happened in the past. The labor market at that level of tightness generates wage gains that are inconsistent with 2% inflation. And the Federal Reserve doesn't think that's going to happen. The Federal Reserve, if you look at their last summary of economic projections, expects that they're going to need to push the unemployment rate up above 4.5% to be successful in bringing inflation down. So they need to push the unemployment rate by up more than a full percentage point in their minds to be successful. And I think that's a reasonable forecast.
Bill, it's Mike. Switching to that jobs report data, the calculations people are making to get to that 4.5% by the end of the year, which the Fed has forecast, we need to all of a sudden start losing tens of thousands, if not hundreds of thousands of jobs a month. Do you see any prospect of that?
Well, I think this just reiterates the tension between what the Fed thinks in terms of how long they have to keep rates high versus what the market thinks. The Fed thinks this is all going to be a very slow process. It's going to take many, many months. And I think when we get the next summary of economic projections from the Fed in June, you'll probably see them being less optimistic about how fast they can bring inflation back down to 2% and probably show a slower rise in the unemployment rate. You're absolutely right. The labor market is still pretty darn strong. And the Fed really hasn't gotten the progress that they've wanted on that score. They need payroll gains of 50,000 or less to push the unemployment rate up by a meaningful amount, and they haven't gotten anything like that yet.
Is there any way they can accurately forecast what's going to happen to wages given this post-pandemic weird kind of labor market that we have?
I think that they can see what's happening through a broad set of wage indicators. And what's happening is not really unusual relative to what you would expect given the tightness of the labor market. If you look at the JOLTS report, the job openings and labor turnovers report, that suggests that the labor market has eased a little bit, but that ratio of unfilled jobs to unemployed workers is still really high. Chair Powell has said that he needs to get that ratio down to about 1 to 1. Right now, I think we're operating at 1.6 to 1. So we still have quite a bit of ways to go.
Speaking of a ways to go, which is, I guess, kind of what policymakers are always going to say, are they there in terms of being restrictive enough, or is there anything in this data or the data that you've seen so far since the last meeting that would suggest that maybe they need to do more?
They think they're restrictive enough. And I think one reason why they think they're restrictive enough is we're going to see some credit constraints from the banking sector because of the turmoil we've seen in the banking area. So they're thinking that credit conditions are going to be tighter as banks pull back a bit. One area, though, where you have to be a little bit concerned is the housing sector, which is really the most interest rate sensitive sector of the economy, seems to be bottoming out. So if monetary policy is really tight and the housing market is starting to recover again, and that does raise a question of whether the Fed is sufficiently tight.
Bill Dudley, I want to go to your latest essay, which has a single sentence in it, which is not inflammatory, but I think shocking to a lot of people. And I'm going to suggest that Bill Dudley, like Stephen Roach, who worked at another shop on Wall Street years ago, you people are looking for a new Fed mandate around Fed stability. Financial stability? Are you advocating a three-part Fed with a responsibility of inflation dynamics, jobs dynamics, and financial stability dynamics?
Well, I guess the way I would put it is financial stability is a necessary condition for an effective monetary policy. If you don't have financial stability, you lose control of monetary policy. So as part of your monetary policy mandate, you have to have a very close focus on financial stability. And the fact is the Fed missed what was going to happen in the banking sector. If you look back at the November financial stability report, there was nothing about the potential funding risk of regional banks. There was nothing about the large mark-to-market losses on their balance sheet. There was nothing about the risk that uninsured depositors might leave.
Right.
So the Fed really didn't capture that. And I give the Fed a lot of credit for the report that they published just recently on what went wrong with Silicon Valley Bank. I think they do recognize their supervisory failures, but that's not sufficient. Monetary policy also contributed to what happened because the Fed basically made interest rates very low for a very long time. They flooded the banking system with deposits. Some banks took those deposits and bought long-dated assets. That didn't work out for them. So the Fed Reserve's monetary policy did contribute to the problems that we've seen in the banking sector.
Yeah, I looked Mike McKee at this and the dovetail here, and it harkens back to Stephen Roach screaming about a new Fed with a new mandate within a modern economy. And whether it was Roach at Morgan Stanley or Bill Dudley at Goldman Sachs years ago, this was the dovetail of market economics into the academic discussion that Chairman Powell has to face every day. And here we are looking at it again.
Yeah, Bill, it raised the question of what do you think the Fed's reaction function is now, given that the new monetary policy framework doesn't apply at the moment?
I think their reaction function is that they're going to keep rates at this level or maybe even a little bit higher until they see signs that they're confident that inflation is going to get back to 2%. And to be confident that inflation is going to get back to 2%, they need to see more softness in the labor market, reduction in wage inflation, and more progress on services sector inflation.
Bill Dudley, Hatzius and McKelvey are on line too, and they just want to guesstimate to you. When do we get under 3% inflation? Give us your market economic analysis today of the timeline to 3%. When do we see it?
I think we'll probably see it before the end of the year because housing inflation is going to come down pretty dramatically. We've seen that the housing inflation in the CPI and in the PC deflator lags a lot behind what's actually happening in housing. So that's going to start to turn down pretty sharply, I think, in the second half of the year. And that will help us on headline inflation.
Dr. Dudley, thank you so much for joining us. Writing for Bloomberg Opinion, superb essay, thought-provoking essay for all in commercial banking here from Bill Dudley on the latest banking crisis and financial stability as well. There's so many ways to go here, Mike. Let's go first to the market reaction. I got a NASDAQ up 0.8%. I mean, this is the optimist case, secular stagflation. No, it's a resilient American economy, isn't it?
Yeah, I mean, I think basically what we're seeing is a reaction to an overreaction after the Fed meeting where people started pricing in rate cuts immediately. Obviously, that's not going to happen, so they've got to readjust.
Amory Horton, in the west coast of Japan, I misspoke earlier, folks, in Tokyo, but really at a lovely resort on the west coast, looking over to Korea as well, with Chair Yellen. I still call her Chair Yellen, excuse me, the Secretary of Treasury, a conversation on Friday. Explain why Yellen is different because of her economics and her Federal Reserve background. How does that make her a different Secretary of the Treasury?
Well, she understands what's going on with the economy and can make her own forecasts. But as Secretary of the Treasury at this time of the debt ceiling, she knows what both sides, Treasury and the Fed, can do. Right. And she'll be in charge of deciding what they will do.
You'll be in charge of deciding. Brief questions for Amory Horton there. She is with Balance of Power, and she will have a conversation with the Secretary of Treasury here. Look for that early Friday morning, 3:30 New York time, 8:30 in London, deep into the afternoon in Hong Kong. Markets on the move after the inflation report. Stay with us. This is Bloomberg.